It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Q1 suggests we are seeing a reversal of the negative supply shocks that so dominated the European economy last year. So easing of bottlenecks, much lower gas prices. So what I would say from all of that is, as of now, 2 weeks away, I think the baseline is that we should indeed increase interest rates in May.
That's the long way of saying we're going to hike in May. Philip Lane, the ECB chief economist, speaking yesterday at the Bloomberg New Economy Gateway event in Dublin, Ireland. Live from New York City, welcome to the program. Your equity market negative this morning. We're down on the S&P 500. Lighter soft, the lower on the S&P by 0.5%. Yields a bit higher by 4 or 5 basis points. The 10-year 362 on a 2-year yield, higher by 6 basis points to 426. Yields higher, double-digit CPI in the UK, sticky inflation in Europe. Bank earnings in America, not terrible. Not terrible at all. In fact, we get a little bit more, don't we, Lisa, this morning? This from Bancorp, US Bancorp, first quarter total average deposits, $510.32 billion. The estimate, $521.54 billion. The stock, Lisa, negative by 8 or 9/10% in the pre-market.
Yeah, so this isn't necessarily meeting expectations, but it still isn't catastrophic, and that's basically the bar that they had to cross over. They said that the average deposit growth that they had year over year was about 12.4%, and that the average loans also came in broadly in line, nearly at $390 billion. So again, they missed on a couple of things, but it wasn't catastrophic. So the shares are hanging in there; they're not just tanking, and this sort of feeds the narrative. Banking crisis perhaps isn't the right way to say it.
We haven't had a shocker yet. I don't know if we will. It's not a judgment about the future, just an observation about what's happened so far.
So defensive.
I'm just waiting for people to kind of message me like, yeah, you see.
Exactly.
You'll see. You wait until Monday. We haven't had a shocker yet. Citizens down, Tom, by 1.5%.
I've had to be difficult here. Lisa's had to dust off the surveillance cork, in that, to me, these are busted marketing schemes in the gauze of being a bank, and that's a pretty severe view. But there's a lot of regular banks out there like US Bancorp, Citizens, and the rest that aren't doing 10-year delayed principal payment mortgages for next to zero interest to be sure your VC transaction works out.
Just say the name, Tom. Talking about SVB.
No, I wouldn't be doing that.
Okay.
But, you know, I like the
basically.
idea of adults running a real business, adapting to what has been clearly a hurtful crisis a lot of people affected. Right now, and this is a joy because Lisa and I have no idea what we're talking about, It is the guy who changed the airline business. Yes, it came over to the United States, but more than anything, Michael O'Leary is someone that the United Kingdom and all of continental Europe knows. I learned this from my daughter the first time she said, "Dad, Dublin this weekend." For John Farrow, it's simple. The flight he takes is from London. Is it Luton, John? How do you pronounce that?
Luton Airport.
Luton Airport.
Yeah.
Luton to Naples, $68.
I can't remember if it was Luton or Stansted. I think it was Stansted to Bari. That's what we used to do.
Okay,
back
there
in the
it
day.
is. Why don't you bring in Mr. O'Leary, since you've flown 5,000 times on Ryanair?
Michael, good morning to you. Let's talk about how business is going, because in the United States, we look at some of the airlines here and things are booming. Is it the same thing, Michael, over in Europe?
Good morning, guys. Yes, it is. It's booming and getting boomier. EasyJet released quite an up-tempo pre-results statement yesterday. I'm afraid we have our full-year results at the end of May, so I'm in a closed period, can't comment, other than what we previously said is, as we emerge out of COVID, demand for air travel across Europe this year is very strong. Pricing is rising. We're seeing the benefit of people going back traveling all summer long. And there's an invasion of Europe being, I'm pleased to say, reports being taken place by Americans coming over here to play our golf courses, visit our beaches, join in our cultural experiences. And I'm very pleased to welcome the Bloomberg New Economy Gateway Conference here to the Garden of Ireland in Wicklow this morning. Although I'm suffering from hay fever, it's not a good day to be in the Garden of Ireland.
Well, Michael, I'm sorry to miss you over in Ireland. Let's pick up on Europe. Capacity. There is a frustration with travellers in the United States. When's the capacity coming back on so that we can get better airline fares and we can be a little bit more comfortable, Michael? How disciplined are you being about that?
We're not. We're taking as many aircraft as we can from Boeing. This summer, we're going to be operating. We plan to carry about 185 million passengers this year, which is up about 30% on our pre-COVID numbers. So as soon as we can get the aircraft from Boeing, we're flying them. But overall, short-haul capacity in Europe will still be down around 5 or 10% on pre-COVID capacity. Some of the European airlines have gone bust. The Thomas Cook's, Flybe, Alitalia, TAP have only returned at half the size they previously were. Aircraft capacity in Germany, where Lufthansa is doubling prices, is only operating at 80% of pre-COVID. So capacity is a challenge. And I think over the medium term, the inability of Airbus and Boeing to deliver any meaningful increase in production means I think capacity is going to continue to be challenging for the next 2, 3, 5 years.
I look where we are, and to me, sitting on the runways, it's about a limitation of airports, whether it's continental Europe or the United States, maybe even Asia. But there just doesn't seem to be enough airports, enough gates. Are you waking up every morning saying to yourself, we've got to get the underlying infrastructure rebuilt for 2030?
No, well, I think there's a differential, Tom, between the U.S. market and in Europe. In Europe, there's many more airports available. There is a focus on 3 of the big hub airports, Heathrow, Paris, and Frankfurt, Maine, which have never really worked that efficiently. Those hub and spoke airports, they're challenging. But there's lots of other airports, second city airports and secondary airports at main cities, which is essentially where Ryanair flies to. The big challenge for us in Europe is air traffic control, which continues to be a mess. The French air traffic controllers going on their recreational striking 2-3 times a week. The French use minimum service legislation to protect the French domestic flights, and they cancel all the overflights.
Okay.
We've been calling repeatedly on the European Commission, Ursula von der Leyen, to do something to protect overflights. So we don't have any issue with the French going on strike, but if they're going to go on strike in France, cancel the French flights and leave the Spanish, the German, and the Italian flights alone.
As recreational striking takes up around Europe and frankly probably globally, I'm curious how much that jacks up salaries and allows people to absorb some of the price increases that you've put out there for Ryanair tickets. And we've seen pretty much across the board, it is getting more expensive and people are paying it without even thinking. When does it become too much? Have you sort of tested the barriers of when people start pushing back?
I don't think, Lisa, we've tested the barriers, but I mean, it's a very unusual, I find myself in a very unusual situation here in Europe. Everybody's talking all winter long about energy crisis, consumer prices, rising interest rates, yet fundamentally we're dealing with an economy across Europe where there's full employment. People are receiving their wages at the end of every month and they're spending money. I mean, I think it feels almost like, I don't know what the 1920s were like after the Spanish flu or the First World War, but it's almost like people are determined to spend on travel in particular. I think that being locked up for 2 years with COVID has driven people back to the beaches of Europe. People have money and they are spending it. It is very difficult to get a restaurant reservation, a hotel, or a flight in Europe. Now, Ryanair is still offering the lowest fares in every market in which we operate, which is right across Europe. But even we're seeing our fares. Last year we saw fares rise by 14-15%. We think this summer, and I'm on record as saying, I think it'll be maybe, we might get to double digit again, maybe 10% increase in airfares. But that's been 2 years in a row of double digit airfare increases. So people are spending. I think we're nowhere near American level of airfares. Southwest's average fare last year was about $110. Our average fare last year was 44 euros. So it's still much cheaper to fly in Europe. But there's no doubt that it is getting a little bit more expensive, particularly as we move through the summer of 2023. But remember, this is the airline industry, and when things are going well, it means the next crisis is probably about 4 days away.
Michael, or another strike. Michael, thank you for being with us today. Michael O'Leary there, the Ryanair CEO, taking some time to catch up with us, even in a quiet period, and we appreciate that. Tom, double-digit increases for airfares.
Yeah, well, we're all living it. Again, I think our American audience isn't familiar with this. There's no frequent flyer miles with Ryanair. You pay $200, and that gives you ability to choose your seat. You remember running to the aircraft?
Oh, yeah. No allocated seating.
40, 50 people?
No allocated seating. So what you would do is you would line up very early, hours before the flight, and as soon as you went first, everyone else started piling up behind you, and then they'd let you through, and you'd sprint onto the plane. And I'd always try and get the exit seats because they had more room, more leg space. Yeah. And then you'd sort of put your bags across the chairs and say, no, that's for mum and dad. That's for my sisters. And you try and block everyone off. But, it was chaos, Tom. It was absolute chaos.
But the fares there, I remember, this is when an offspring, this is the middle child, was flying around Europe every weekend, and it was cheap.
I could get a ticket to Italy for 15, 20 euros.
Like 15, Lisa,
20
flying
pounds.
to Washington is outrageous what it costs.
So
it's outrageous.
Can you still get those cheap flights? I'll ask that. At this point, is it the same kind of story? And, oh, by the way, do you still have to run to get the seats? And do you still block off seats? You were that person? Really?
Of course.
Oh, jeez.
I got there first.
And then you booted everybody else out. I can imagine the fist fights.
I was a kid.
Is that your justification?
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Talk about Starbucks for a moment. You've been on the board for how long?
Wow, a long time, since 2006.
Okay, and when you got on the board, did you have to go to Starbucks every day and
I go to Starbucks a lot.
And
yes.
when you check in, do you have to wait in line like everybody else?
Yes, I wait in line like everyone else. That's an important part of the process, to see how everything's working, how long it takes, what's happening in the store. I take pictures of the cases. I do all sorts of things when I go in now.
So what's your favorite drink, can you say? Is that a state secret?
I make a joke about this. So I like my coffee black like me.
Okay. Now, Howard Schultz has been a mentor to you a bit. Is that correct? He's the founder of Starbucks.
Sure, for sure. Very important.
So what did he do that made Starbucks so successful? There are other coffee chains around the world, and it wasn't like he invented coffee chains. What did he actually do that made it the biggest in the world?
He really started off from the very beginning saying that he wanted to create a different kind of company, and that he had this point of view about leading through the lens of humanity. It sounds like it could be a cliche, but it's not at all. It is very much in the DNA of the company, how we look at things, how we do things. It's always through this point of view of people. And so at the end of the day, I think he put people first, not only in terms of the partners of the company, but also in terms of the customer. And at the end of the day, that is what has made the company so great.
Well, Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
It has been a very thin rally. There's certain parts of the market that are doing well, others that continue to struggle.
It's remarkable the way that the economy has performed in the face of such rapid increases.
The consumer balance sheet overall is in good shape. Business balance sheet overall is in good shape.
There is still a lot of residual tension related to liquidity within the banking system.
You're in the transition period. We had 14 years of low interest rates, and the real impact on valuations, it takes a while to filter through.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Here's the good news. Things aren't terrible. Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures right now negative on the S&P 500 by 0.5%. But let's take a snapshot of some of the regionals in the last 24 hours. Western Alliance flying at a pre-market up by more than 18%. Other names, Citizens, US Bank Corp, just doing okay. And doing okay is good relative to the fears of the last month, Tom.
It really is, and it comes off, let's remind ourselves, off the big banks with a revenue pop that we saw at some of the major banks, including JP Morgan. I'm not sure we see a revenue pop here, but what's different is when the Bloomberg headlines come out. Excuse me, I got the plague today. When you got the headlines coming out, John, they're leading with those deposit metrics that people want to know. That's the mystery, and it appears to be good news.
And that's where the focus is stable. Stabilization is this word we keep coming back to, Lisa, over the last couple of days.
Yeah, because honestly, they did miss. Let's just be honest. They missed with the deposits. They missed on some of the earnings. There was not necessarily this incredible strength and roar of just, everything, all systems to go. And the stock's pretty much flat in the pre-market trading, which shows you people were expecting Armageddon for these banks. They basically had priced in a true credit collapse in some of the regional firms that isn't happening. So does that signal all clear, or does it just signal that, a tail risk is taken off the table and that basically all the bad news has already been priced in that could come from tighter lending
It's all
conditions?
relative. I said it at the start. The good news is things aren't terrible. The decision you have to make now, and we keep leaning on this, this is how things stand at the moment. Do you see the last month as a one-off event we can leave in the past, or the beginning of a process that leads to tighter financial conditions and, Tom, tighter lending standards?
I would editorialize it this morning with the VIX at 17.47. We'll do the data in a moment. We are beginning to price in a Fed that's moving from bank crisis to bank distraction. That's how I'd put it. You see it in the 2-10 spread, which is very elegant with a support. It's 60 basis points of inversion, and we're now down at 65, breaking through that support, which goes back right to the crisis of, let's call it, March 10th.
We're pricing out rate cuts at the front end of the curve. The 2-year is higher, repricing higher by 6 basis points. The 2-year right now, 4.26. That move has been validated to some extent by some of the recent data from the Federal Reserve on bank lending. on bank loans more broadly, and Lisa encouraged by some of the Fed speak over the last couple of days as well.
Basically saying, look, guys, we still are going to keep rates high for a longer period of time, and so you are seeing only 0.5% of rate cuts being priced into the market through the beginning of next year. So still, there is that kind of expectation. I will say what Ryanair's CEO, Michael O'Leary, just said really struck a chord with me. This idea that people have money and they want to spend.
Boom time.
Boom time. And it's getting boomier, to use his words. And this idea that they're willing to pay up for tickets, even though the experience, not necessarily Ryanair, but generally, is getting more miserable. I'm just saying, you know, this tells you where we are,
like
and
a
that just keeps
woman
going.
who's been stranded at
All right.
Hartsfield
We don't need to bring
in
this up.
Atlanta
We
3 times.
don't need to bring this
With
up.
Delta.
3 times.
With Delta.
No,
She's
just-
got there's a
there's-
brass plaque
We don't
down
name
Terminal
airlines.
C. There's a brass plaque in Atlanta. Bramo set up shop
Look
here.
at those markets.
Do you want me to look at the markets? I'll do that for you. Okay. The equity market more
Failed
broadly on the
vacations.
S&P 500 down about 0.5%. I'll whip through things for you just on a surface level. Then Lisa will give you the day ahead in just a moment. Equity softer, yields higher. We've talked about the 2-year. Let's talk about the 10-year. Up 4 basis points here. The 10-year. 362 in the FX market. Just a touch of dollar strength here, Tom. Euro dollar 109.33.
Again, indicating crisis over. The 10-year real yield really breaks out 1.31. I don't want to make 1.32 actually. I don't want to make too much of it, but I would suggest to May 3rd we're seeing a reset this morning, moving beyond angst of what Secretary Yellen will do about the banking crisis. Well, you know what? Maybe there's nothing to do but figure out the marketing schemes that went wrong.
I think we hear from her on China a little bit later this week as well.
There's a lot to say on China.
Looking forward to that. Lisa, just looking at crude briefly, just a break of 80, sub 80, 79 on WTI.
Well, today we're going to be watching bank earnings. We haven't mentioned Morgan Stanley. Does anyone care? We've seen Morgan Stanley shares do okay so far year to date. That comes out around 7:30 a.m. Again, though, that's not really where people are focused right now, because the existential crisis that wasn't, perhaps, really is in the regional banking sector. We got Citizens, we got U.S. Bancorp, not anything fantastic in terms of some sort of catastrophic surprise one way or another. Do we get that same tone from Signature, Silvergate, Zions Bancorp, which will come out after market today? We have seen those shares all pummeled so far, with Zions down 38% year to date. So what kind of confirmation or a rebuttal of some of that weakness do we see in the results? 2 p.m. we get the Fed Beige Book. The bifurcated nature of inflation, of growth, is what I'm watching at a time when people don't know what to make of this economy. That is what I read from Bloomberg Financial Conditions Indexes, going from deeply negative in the immediate aftermath of Silicon Valley Bank to basically bouncing right back. Crisis over. Is it? Where are we in terms of this economic cycle? Fed speakers are going to be trying to make sense of that, whether people listen to them. Another story, Chicago Fed President Austin Goolsbee will come out at 5:30 p.m. Very interesting, after he talked about the need to be cautious with rate hikes. And New York Fed President John Williams at 7 p.m., who has been a little bit more hawkish in terms of, we need to raise rates, we're not going to cut rates. And John, that is the debate playing out under the surface in markets, with people saying, okay, well, we can't sound the all clear in terms of Fed actions. And I don't know if 60-40 is going to work in that kind of environment so consistently.
Let's build on that. Lisa, thank you. Joining us now is Tracy McMillan, the head of global asset allocation strategy over at Wells Fargo. Tracy, welcome to the program. Always good to see you. Do you see reason elsewhere to price out the rate cuts priced in over the last month?
So we do see a reason for pricing those out. We do think that the Fed is near its terminal rate, and actually when markets tested it going any higher, that was back in March. We saw some breakage in the financial sector, and so we have had expectations pull back since then, to the point where we were seeing rate cuts priced in, but we think that's going a little too far. We expect, another 25 basis points here in May, and then the data will determine if we get another in June, but we think they hold from there, and probably 2024 before we see those cuts.
Tracy, to your incredibly smart note, buried in it, you midpoint SPX at 4,100. We're basically there right now. If we go to 4,200, or dare I say 4,300, do you suggest people hold and understand they may pull back? Or do you lighten up if we get this bull market to continue?
What we've been telling investors is that we're probably going to end the year about where we are today. And that's not only in large caps, but across the equity asset classes. So if we move towards the top end of that range, then we think it's an opportunity to start to trim and move back in if we go back to the lower end of the trading range. And that's going to be in the 3,800 area within the S&P.
Tracy, when was the last time that you were this tactical about when to enter or exit at a time when the fundamental stories change every day and it's very hard to get a narrative?
You're absolutely right, Lisa. It is hard to get a narrative, but our narrative has been very consistent over the past year. We've been more conservative. We have had an underweight to equities relative to fixed income, but for the past, call it 6-8 months, we have seen this trading range develop, and the equities are just having a difficult time getting past that 4,200 level. And we think that there is a recession ahead of us. Economic conditions are going to weaken, and so we take advantage of this strength here to reposition into a bit more into conservative assets like bonds.
So people who are more conservative say that the equity market hasn't been able to break above 4,200. The bulls out there are saying the fact that the stock market is hovering around these levels shows just how resilient the economy is amid all this bearishness that has gotten completely overplayed. How much of a pain trade is stock markets going up at this point, given what some people are pointing to as decade records when it comes to bearish positioning?
The bearish positioning matters less to us than the valuations and the conditions that we see in the second half of this year. So we do see the economy starting to weaken. We do see a recession ahead, and we do see an earnings recession developing. We think earnings are going to fall in the S&P 500 to about 205 this year. And we just don't think that all of that is priced in yet. And also, I would point out that even in bearish conditions, we have seen markets move lower. So it is possible for that to happen.
Tracy, wonderful to get your perspective on a market that is slowly repricing those rate cuts. Tracy McMillan there of Wells Fargo on the bond market, some of the recent data we've had, and of course the bank earnings of the last week or so as well. Tom, we need to talk about companies, to borrow a phrase from a wise man. What do companies do, Bramo?
They adapt and adjust.
Well done.
Thanks.
They adjust and they adapt. They also cut staff too.
Yes.
Lots of jobs to go. Meta, Disney. The latest news on Meta, according to a memo seen by Bloomberg News, the Facebook parent company told managers that they should prepare for job cut announcements today. Tom, layoffs across Facebook, WhatsApp, and Instagram. And Disney, I think, in the mix as well. I would also suggest companies have learned that you don't come out with a big announcement, and particularly on Wall Street, maybe it's 20 here, 50 there. On Thursday, we'll do 422 worldwide, whatever. But there's a more sophisticated way of doing this now than previous joyous times. Would you say that the tech companies have embraced the sophisticated way of doing that? Because Facebook has not been shy about making cuts. In fact, that's part of the strategy, isn't it? Yeah, the zeitgeist here is that these Silicon Valley titans have figured out, oh, we get more done with fewer people. What a shock that is. That's Roger Martin 101 from the University of Toronto.
They also hired a lot of people. They hoarded labor who didn't necessarily even have a job, right?
COVID,
there was a lot of excess for them to trim.
There was an excess developed, but they're also finding there's an improvement in process when you get rid of the excess. It's really, I mean, Amazon alone is a study right now. Oh, the pre-pandemic and the pandemic boom. The pandemic boom of hiring at Amazon is still just absolutely phenomenal. The workforce essentially doubling over a couple of years. Your equity market negative this morning, down 0.5% on the S&P 500. Morgan Stanley results this hour.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Republicans will vote next week on a bill to raise the debt limit and impose new cuts to government spending. President Biden and other Democratic leaders are refusing to offer any concessions. Republicans are betting that if the House passes the bill, that can ramp up pressure on Democrats to consider compromises. The debt ceiling has to be raised or the U.S. runs a risk of a default. Another strong inflation reading is raising the likelihood for more interest rate hikes at the Bank of England. Britain's consumer prices index rose 10.1% in March from a year ago, driven by the strongest increase in food prices in more than 4 decades. The pound edged higher and UK government bonds sank after that report. Fox News has avoided a potentially embarrassing trial. The network agreed to pay $787.5 million to settle a voting machine maker's defamation lawsuit over its 2020 election broadcasts. The settlement was for less than half of what Dominion had asked for, but was far above some analyst estimates. Fox has aired bogus claims that Dominion rigged the vote against Donald Trump. U.S. lawmakers have accused Credit Suisse of impending its own investigation into its historical assistance to the Nazis. The Senate Budget Committee says the bank established a narrow scope, refused to follow new leads, and removed an independent ombudsman overseeing that probe. Now, Credit Suisse rejected what it calls misrepresentations and says it's cooperating with lawmakers. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
He
story.
is there, the kind of upside.
American debt is a ticking time bomb that will detonate unless we take serious, responsible action. Yet, how has President Biden reacted to this issue? He has done nothing. Defaulting on our debt is not an option. A no strings attached debt limit increase will not pass.
Folks, we know there's more to do. And yet yesterday, the Speaker of the House of Representatives, Kevin McCarthy, went to Wall Street. He threatened to be the first one to default on the debt, which would throw us in a gigantic recession and beyond, unless he gets what he wants in the budget.
House Speaker Kevin McCarthy and President Biden talking at each other and not with each other right now, and that's a problem. Might become a bigger problem later this year. Live from New York City, welcome to the program. Let's talk about the next hour, never mind later this year. In the next hour, earnings from Morgan Stanley. Shanali Bassett dropping by the studio to get us up to speed on that. She'll break it down for you when it drops. The broader market looks like this morning. Negative on the S&P 500. We're down by 0.5% on the S&P. More broadly into the bond market, yields higher by 6 basis points on a 2-year 4.26. I think the theme at the moment, Tom, just repricing that rate cut story, pricing out some of those rate cuts.
Yeah.
potentially a discussion about pricing in some rate hikes. Don't think we're there just yet. In the FX market, some dollar strength reflecting some of that. Euro dollar negative here, a third of 1%, 109.32.
I'm not to rate cut analysis. I'm to what are we doing about a rate rise? And the answer is it's more evident this morning. I do want to point out, John, with all the enthusiasm and worry, the VIX 17.43 is still remarkable. Remarkable as well in Washington, our Bloomberg Washington correspondent, always remarkable, Amory Horton. Amory, I want to talk about in a clumsy Washington day, the drip that we're getting from this theft of our intelligence secrets. Is it just understood by people like you that we need to get used to every day? I mean, today in the Washington Post, it's China with a super spy drone, whatever. But are we going to get used to where every day for the next 30 days we're going to see new information come out?
I think that's right. We just don't have an end date. There's really no timeline that we could forecast when this would end. I mean, remember, the U.S. government didn't even know these documents were circulating when they first were put on Discord. But potentially today we'll actually get some more information because that individual is to be due in court. He has not yet said what his plea will be, but he is to have a court date today. So potentially there's going to be more information that the U.S. government has regarding the caliber and level of intelligence that this individual was able to leak.
An unfair question, but is this stuff so sensitive that the court process will be behind closed doors in private, or will it be a normal court case? Do we know yet?
We don't know yet. I mean, again, he has not even entered his plea yet. So I think for that, we just have to wait and see. And it's just unknown exactly how this is going to play out. But Well, you do bring up a good point, and just quickly, a totally different case, but the Fox Dominion case that ended up being settled, that was going to be taken. That was going to potentially have a little bit of cloak and daggers around it as well, with the jury selection and some of this stuff as well. So it really depends on the case, but we just don't know yet.
I want to shift gears a little bit because as we watch the drip of intelligence, we're also hearing about Treasury Secretary Janet Yellen giving the most extensive speech on China-U.S. relations since she took her position. I'm curious from your vantage point, do we have any sense of what she's going to say or why now?
So I would say why now is because she alluded to the fact that she plans to go to Beijing at some point. I think there's been some interesting rhetoric coming from the United States when you look at Secretary of State Antony Blinken's G7 meetings with foreign ministers leading up to the Hiroshima meeting on the ministerial level about engaging with China. And then the Treasury sends out this media alert, and I'll read you a little bit of it. It says that during her remarks, Yellen will underscore that in its bilateral relationship with China, the U.S. proceeds with confidence about enduring fundamental strength of the economy, historic advancement. They want to talk about national security, protecting human rights, and taking targeted actions to advance our vital interests where needed. So she's really setting up how the U.S. views their economic relationship with Beijing. And obviously this comes at a very interesting time. The IMF is talking about fragmented geopolitics and how that can weigh on global growth. You have Emmanuel Macron leaving Beijing, saying that they do not want to decouple. And then Brazil's president, Lula, just got back from a trip to Beijing and criticized the United States for not wanting peace. So it looks like the U.S. wants to make sure their voice is heard.
And what is that voice? I mean, that's the issue, especially how closely it coheres with what not necessarily we heard from Emmanuel Macron, but whatever the European mainstream view is, whatever that might be.
I think it's that they want to make sure that they're going, combating China, competing with China, actually is what they would say. They want to compete with China alongside their allies. They want to probably set some guardrails, I imagine, in this speech. You can read the tea leaves of that, but also want to make sure there is a lane for engagement. Whether that's on climate or other major discussions, they want to make sure that they are getting back to the table and discussing with China. Remember, there is a number of issues that really sidelined a lot of these discussions since Biden sat down with Xi Jinping in Bali. Secretary of State Antony Blinken was supposed to go. Raimondo is supposed to go. Yellen's supposed to go. No one has trips planned, scheduled on the books. And that's because of fresh flashpoints in the Strait of Taiwan, the spy balloon, Xi going over to Moscow and not also calling Zelensky, but offering this peace plan. I mean, there's a number of huge issues between these two countries, and I think this is a moment they're trying to find an opportunity to engage on at least something like climate.
What's the president do today? It's a Wednesday. It's a complete nudge news flow. What do you do on a day like that if you're president of the United States?
Well, according to the White House, the president will be going to Maryland today, and he's going to be speaking to a union, and this is where they train. A union training facility. And according to the White House, and I have his schedule in front of me, Tom, it says he will be delivering remarks contrasting his vision for the economy with MAGA House Republicans' vision, an economy that goes from the middle out and bottom up. You've heard this before. This is almost a campaign event, but not so
there we go.
Set in black and white campaign event.
I mean, I don't know what happens in the United Kingdom. Does the prime minister have a boring day? Does the president like sit there and wake up and go, what am I going to do today?
You think that happens often?
I don't know if it's often, but it's, I think, really going back to the advent of the White House. It's
I think your view on that probably depends on the party you vote for.
No, I just think they wake up and they go, it's Wednesday and there's no big events.
Well, he has a Congress divided, and he's waiting for a debt agreement, or he's waiting on the Republicans to see his vision. He mentioned this yesterday. I'm sure today he'll talk about the debt limit as well.
Like the president wanted 2 scoops of ice cream, President Trump. What does President Biden want? Does he have
Biden wants the ice cream.
Does he want the ice cream
wants the ice cream. I don't know why we're doing this. I think you're describing your day more often.
No, I think it's a nudgy day in Washington. They're allowed to have a nudgy
Down
day.
in Washington, TK wakes up. Is Morgan Stanley coming out this morning?
Yeah, I mean,
it's important.
Yes, it is. Are you sure? Yes, it is.
Shanali's so on it that I don't have to worry about that
Morgan
stuff.
Stanley is coming out this morning. Shanali, in the next couple of minutes. Good morning to you. What are you looking for from this
Morgan
name?
Stanley is the most expensive of all the banks. It is trading more richly than every single one of the large ones. And the reason is because the market loves what they've done with asset and wealth. I think what's interesting, and I was just looking at this, across all of the banks, it's not that people look at Goldman Sachs yet and say, okay, let's value this based on the asset and wealth manager. Same with JP Morgan, even though it's among the highest returns on equity at the bank. And so does Wall Street start to shift its thinking around what banking means? Because the reality is the deposits and the loans are coming from that business.
Bloomberg with a great article this week on Mr. Saperstein, who's one of 3 to replace Gorman. Is Gorman like Diamond in that he's like chairman and CEO as well? Is it the same structure,
I mean,
dominance?
he definitely has a stronghold on the bank. And you think about the history of the leadership kind of struggles at the top and the fight even to be president of Morgan Stanley, let alone the CEO of Morgan Stanley. Andy Saperstein was a longtime lieutenant of James Gorman. I think what's interesting also is they come from consulting backgrounds. And I think they're showing that their strategy prowess that comes from consulting is kind of beating out the investment bankers these days.
Well, John comes from a consulting background.
I do, yeah. Yeah. An Italian family.
I know that.
You learned very early. Shanali, thank you. Wonderful. Shanali's going to be with us as those numbers drop from Morgan Stanley. Then we'll catch up with Gerard Cassidy of RBC Capital Markets. That's basically the chain of events for the next 10 minutes or so, with equities down 0.5%.
Tell us about consulting in the kitchen. Do the dishes.
Oh, pretty brutal. Pretty brutal at dinner time. You learned fast how to argue.
Yes, I grew up in the same environment. Just pitched battles at the dining room table.
Just, an important note. I would order so much ice cream if I was in the White House. Just all the time.
I know. You'd have either lemon, gelato, ice cream or gelato.
Just ice cream, just vanilla, but a really, really pure, wonderful vanilla ice cream.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Equities lower this morning. Good morning to you. We're down 0.5% on the S&P 500. Welcome to the program. We're down 0.75% on the Nasdaq 100. Outside of that, in the bond market, repricing yields higher over the last couple of weeks. Your 2-year has gone from the 350s at the end of March back through 4%, 426, very close to 430 a little bit earlier this morning. Yields higher by 6 basis points on a 2-year. On a 10-year, yields up by 3 or 4 basis points. On a 10-year to about 361. Some numbers from Morgan Stanley to wrap up earnings season for the big banks on Wall Street. Shanali Basak alongside us. Shanali, what have you got?
Let me give you the first blush here, because you have equity sales and trading revenue coming in below analyst estimates. We'll talk about that in a second, why that's a big deal. You do have fixed income sales and trading coming in above estimates. That makes 4 of the 5 biggest banks coming in above estimates there. You have wealth management revenue coming in above estimates as well. That is, the behemoth in the room over at Morgan Stanley. But on the equities number, listen, that means this is another quarter in which Goldman not only beat estimates, they also came in above Morgan Stanley in equities trading. This is a core business. They have traditionally been the biggest on Wall Street when it comes to equities trading. So what is happening? Are they losing share? Is this a client balance issue? Is this a market issue? It is a soft market when you look at the equities market. But remember, we are one large prime broker short in the world without Credit Suisse. So why isn't Morgan Stanley picking up more share?
First quarter wealth management, the revenue above estimates, 6.56 billion. The estimate 6.48. Just to look at the pre-market response to this. Early days, of course, we're higher by a little more than 1% in the pre-market to 90.88. This line right here, I think this line important for the whole industry right now, Shanali. The investment banking activity continued to be constrained. No signs of that picking up at the moment.
It's looking ugly out there. And remember, we want to kind of dig a little deeper a little bit later on and see if they also are talking about their securities portfolio and if they're talking about the loans that they have on their book. Remember, we're watching all these banks in real time kind of work through all of these hung loans before they can get to the new set of lending. Remember, private equity is still out there raising money. We had Goldman yesterday saying the fundraising environment is also kind of muted here. But again, they are looking to the end of the year to pick back up. Headcount right now is up at many of the big banks still. Do they have work ahead of them is the really large question here. I also want to, real quick, Tom, I want to look at the asset flows here really quickly, because remember, Morgan Stanley is supposed to be the biggest beneficiary here of the Silicon Valley Bank troubles here. And investment management has net revenue of 1.3 billion, even AUM of 1.4 trillion amid asset declines. They have higher net interest income, not only driven by higher rates, but people are taking out loans from Morgan Stanley.
They say this. I like it with Gorman with a paragraph right off the top of the note. He talks about investment banking constrained, but I really like the comment, a very unusual environment. So how do they differentiate forward? What's the, you're so in tune with the zeitgeist, you're Shanali. How do they differentiate? It can't be just cost control and laying off bodies. There's got to be a strategy.
listen, remember, Morgan Stanley still has this intense base of asset managers and financial advisors across the United States. When I talk to my sources there, they're having an easier time hiring, actually, because they don't have the same type of competition elsewhere, technology or other places that they might have had before. The asset flows of $22 billion is pretty interesting.
John, just buried here, or Lisa, quickly here, investment banking revenues down 24% from a year ago. I guess that sort of colors it.
Which is the reason why the diversification is so important for some of these banks that we've been hearing about time and again. Just real quick, Shnali, what do you make of the provisions for credit losses coming in significantly higher than expected? Still nothing to write home about, $234 million versus the estimate of less than $100 million. Is that significant?
The reason it's significant is because they now are just another bank that are telling you that they think that things are not kind of falling off a cliff here, but yes, the environment is getting tougher. So far, the banks have been rewarded for those provisions anyways, because it shows you that they're lending harder. They're willing to take on some losses in order to extend more loan and pick up what they can in net interest income.
All right, now Gerard Cassidy joins us. He's been such a friend of the show to give us perspective across these many different types of banks, not all pooled together. And Gerard, I want to start with a sentence buried in their very clear press release, which is all about Morgan Stanley, all about what you and I have witnessed over decades. In all this turmoil, down, 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 wealth management moved from a $5.9 billion revenue stream to $6.6 billion. Boy, Gerard, does that talk about why everybody wants to copy Morgan Stanley?
Tom, you're absolutely right. You know, the wealth management business is a more predictable, steady Eddie type of business versus the more volatile institutional business that you guys have been talking about. Tom, you mentioned about how much the investment banking revenues have declined, not just for Morgan Stanley, but for the group. But wealth management, you're right, that differentiates Morgan Stanley from his peers. And under Gorman's leadership, he's the one that drove this over the last 10 years.
Jared, we've had all the big banks report now. Who won the quarter?
I would say that, you know, the JP Morgan numbers probably stand out, John, as the winning the quarter. They certainly drove those numbers through that net interest revenue line. Certainly, they also had, you know, relatively decent capital markets businesses, but it was all against expectations. The numbers, as you guys have pointed out, relative to a year ago, is still very weak, especially in investment banking. But I would put JP Morgan at the top of the list.
We've been focusing very closely on total deposits at some of the regional banks. Here in Morgan Stanley reports first quarter total deposits below the estimate, $347.5 billion versus the estimate of $352.2 billion. Does that matter, or is this basically not a question? It's a rounding error that we don't have to pay attention to, Gerard?
I think it's, I don't want to say we don't pay attention to it, since we pay attention to everything, but I think you're going down the right path, Lisa, that it's not a material issue. Deposits, we have to remember that, you know, the Federal Reserve is implementing quantitative tightening with the intention of reducing deposits out of the banking system after they created over $3 trillion under QE. So the entire banking system is going to see their deposits shrink. And the real question is the mix of your deposits. And the regional banks and the big money center banks, as well as Morgan Stanley, have good core consumer deposits, which are critical.
What's going to be the profit driver at a firm like Morgan Stanley if investment banking doesn't pick back up, if you are seeing transactions in the capital markets atrophy?
Lisa, it's really the critical question for these investment banks. You know, it's out of their control, of course, in dictating how the market's going to behave in investment banking. So hopefully the first checkpoint will be monetary policy. The Fed has to stop raising rates. So if we get to that terminal rate in the second quarter, hopefully the second half of the year, you'll see a pickup in the investment banking activity because it's a more stable landscape.
Gerard, I look at the 2013 letter of Morgan Stanley written by Mr. Gorman, and there's a subtitle, Investing in Our Businesses. How's Eaton Vance doing? How's E-Trade doing? And all the other things he pieced together here to win at wealth management and managing people's money.
Tom, it's a very good point, because they have not only grown organically, but inorganically through the acquisitions that you just identified. And as we know, in the asset management business, which is, of course, Eaton Vance, economies of scale are critical. And so as they built their economies of scale, including their organic growth as well as other acquisitions in the asset management business, that has obviously helped them. On the E-Trade, it's also given them a diversity of customers. As you know, E-Trade is more of a self-directed product line versus the traditional Morgan Stanley wealth management business. So it diversifies their revenues, and you have to give Gorman credit for doing those acquisitions.
Joe, just to wrap things up, just one question to you. We've asked this to investors. I'd love it from a bank analyst just to answer it. Do you see the banking events of the last month as a one-off event that we can leave behind, or the beginning of a process that leads to tighter financial conditions? How does a bank analyst answer that question?
From the get-go, John, I was saying to myself it was a one-off event, and the reason being is that those business models that Silicon Valley Signature had were so different. Now, that doesn't mean we're not going to see somewhat tighter lending conditions, not so much because of what happened in March, as it might be called March Madness. It really has to do with what the outlook is for the economy. And as Jamie Dimon said on his call, it's not a credit crunch. Yes, maybe there's a thumb on the scale, but banks are in the business to lend money at risk-adjusted rates of return. And if they see good risk-adjusted rates of return, they're going to lend money. So that's the real critical question. What is the outlook? Not necessarily what happened in March.
Joe, thanks for being with us so much through March Madness and through April as well to break down some of these earnings. Gerald Cassidy of RBC Capital Markets. Just to recap Morgan Stanley, wealth management revenue a little bit better than expected. Trading revenue for FIC a little bit better than expected. Shonali, what do you see now? Where's Morgan Stanley? Down by a little more than 1%.
I think that equities trading number is still a big deal. And to Lisa's point, that missing on deposits, there's going to be questions about that, certainly on the call. Remember, the number is higher, a bigger jump than they saw in the prior quarter, but it did miss analyst estimates. And the reason it's a big deal is after Silicon Valley Bank, after First Republic, presumably that clientele would have moved over to Morgan Stanley. So how much did they actually pick up? And that question of how sticky are those clients is something that will be asked more.
Also, the constraint on some of the capital markets business at a time when that was such a big profit driver. How significant and how deep is that constraint? Do we have any sense?
One thing that's interesting, and this is not quite investment banking in the advisory sense, but look at the value at risk at all the banks at the trading desks. They're inching lower. So in addition to provisions for credit losses, you also have them really dialing back on trading risk appetite. And again, with Morgan Stanley's client base, I would reckon that they would get some questions on the call too about that.
Usually, Shonali, I'd say see you next quarter. Great work. But we've got the regionals now, haven't we?
But tomorrow's a long day.
Going to be just as busy.
And so is Monday with First Republic. Until we hear from them, it's hard to say we're out of the woods.
Off the COVID bottom, Goldman Sachs up 133%, Morgan Stanley up 231%. There's the delta.
Goldman's been doing okay, hasn't he? He's been doing okay.
I love talking to him when we go to Davos, and there's Shonali elbows me. She gets 2 minutes for elbowing. She says, "You're not talking to Gorman. I'm talking to Gorman." And so she talks to Gorman, and what they're doing. I mean, Eaton Vance was a wonderful firm. Doze Gardner ran it up in Boston, totally class act. They invented the tax advantage mutual fund, literally invented it.
Right.
And he goes, we can acquire this and build it out. And that's the Gorman way, going back to Smith Barney.
Nobody else has done deals this big since the financial crisis, and he's inked 2 of them.
And is quietly. Yeah.
We done?
I'm done.
Shonali, thank you.
I'm done.
As always. We'll talk about those regionals a little bit later on. That's the banking story for this morning. Anastasia Amoroso, the Chief Investment Strategist at iCapital, is going to be joining us shortly. We've been in this very tight, well-defined trading range for the last couple of months, 38 to 4,200. At the start of this month, Anastasia said we'd break out of it to the upside, and we're very close to doing so. We'll continue that conversation next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Fox News will pay $787.5 million to avoid what could have been an extremely embarrassing trial. Fox agreed to settle a defamation lawsuit by Dominion Voting Systems over the network's 2020 election broadcasts. Dominion says Fox blamed it by airing claims it rigged the vote. Evidence showed that Fox executives and stars derided the conspiracy theory even as they promoted it. It's official. India is now the most populous nation in the world. According to the United Nations, India's population is now almost 1.43 billion, edging out China. The increase would put more pressure on India's Prime Minister, Narendra Modi's government to create jobs. There's another sign that Tesla CEO Elon Musk is willing to sacrifice profits to boost demand. The electric car maker cut the price of its long-range Model Y SUV by more than 5% to just under $50,000. The cost of the Model 3 fell 4.7% to just under $40,000. Tesla reports first quarter earnings today. Bloomberg's learned that Disney plans to cut thousands of jobs next week. That includes about 15% of the staff in its entertainment division. In February, Disney said it planned to eliminate 7,000 positions from its workforce of more than 220,000 as part of a cost-cutting move. And hedge fund billionaire Ray Dalio plans to set up a branch of his family office in Abu Dhabi. It's part of his deeper push into the Middle East. Bridgewater Associates founder has cultivated a close relationship with United Arab Emirates leadership over several decades. Dalio's net worth is estimated to be more than $16 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it be okay? Is getting ready to make.
We've had a major, significant turmoil in the banking sector that came with a substantial intervention on the part of the authorities, and that will have to come with regulatory changes, and all of that simply does not take us back to where we were before March 8th.
March 8th, that line in the sand before SVB blew up. Vishy Tripatur there, the chief fixed income strategist over at Morgan Stanley, weighing in on this price action. March 8th, the 2-year was north of 5%. The 2-year dropped to the 350s by the end of March, and now the 2-year is close to 430. Yields are higher this morning. Here's the price action, up and away by 7 or 8 basis points on a 2-year, 427. On a 10-year, up 4 basis points, 362. The equity market's softer, negative, down by 0.5% on the S&P 500. If we can pick out Morgan Stanley, let's just breathe some life into the conversation around this bank again. Morgan Stanley in the pre-market's down by about 2.4%. Lisa Wealth Management tick, okay, that's fine. Better than expected. FIC trading tick, okay, that's fine. Then this build for loan losses. What do you make of that?
Well, it was more than twice as much as people had expected, more than $200 million. Still not a huge number relative to their balance sheet, but still, it highlights what Shanali was talking about. Some of these banks are willing to get more aggressive with their loans, and they just know they have to write more off as a result. And how much does this go to underwriting activity? How much does this have to do with really trying to capitalize on the fact that people are still spending, even though perhaps a greater proportion of them may not be able to pay it back in the future?
And just another note of caution, Tom, around the investment bank constrained, and that's more broadly the story right across Wall Street right now. IB is constrained.
IB is constrained. That's French for layoffs coming. And let's be clear, that's the easiest place to have bodies move out the door. It's just, these decisions can be made literally over a cup of coffee. There's other cost cutting that has to occur, which, particularly with the big banks, I really wonder about the future of retail banking. Like with COVID, do they continue to speed up the digitization
and move away from branches? How long have we been talking about that now?
Well, forever, but there's a real, I think, inertial force going on right now. We'll look at the banks, and as John mentioned, this continues in the coming days. Never before have we looked at the smaller banks like we're looking at them right now. And this is going to be good. This is what you need, folks. Should we talk to someone who just possibly got it right? Anastasia Amorosa joins us now, Chief Investment Strategist at iCapital. And I just love what you say. It's tough to be a bear right now. And this goes into the panic of I'm a bear and I've got to move away from that stance. Where are we in that continuum right now?
I think people are starting to have a little bit of a fear of missing out. I mean, the fact that this market has been so resilient around this $4,000, $4,100, maybe even $4,200 level, that's starting to get investors thinking. I mean, first of all, you had systematic investors, commodity trading advisors, CTAs, that have been in performance chasing mode already, or they had to keep covering the shores. You have the hedge funds that have been buying tech because they were caught being underweight tech. And I think that's going to likely spread to other segments of the market. Mutual funds have been underweight, so they may have to move into at least market neutral position. And then, of course, the retail investor. So, Tom, I think the longer this market hangs around these current levels and, the longer the economy is not cratering, that's going to get people back in.
Lisa, you had that great chart yesterday. You and other people put it, I believe, from Bank of America. That it was stunning, the gloom equivalency to 2008, 2009.
Okay, and not to just basically confirm my reputation as being gloomy, but is this basically...
No, I don't mean that.
But hold on a second.
It went viral.
There was this idea that
as
because
viral
things
as Brammo can be.
are bearishly positioned, that we could potentially have a pain trade of stocks going higher. Are we just dancing while the music's still playing, even though we know it's going to end at some point?
Look, that's the uncomfortableness of it all, right? We can't sit here and make a call on what this economy is going to look like a year from now, and therefore the market is going to look from now. What we can say is we can look at the next quarter's worth of data and say, look, for now the consumer is resilient. For now we're managing to process 5% rates, and therefore for now the economy is cooling and not cratering. And so I think for investors, maybe this is a different way of thinking. We're used to saying, low interest rates are going to be with us for a while and just be in equities and there's no alternative. And now you need to be more nimble, you need to be more tactical and recognize that, maybe you don't want to, get out because that recession is not imminent yet, but the circumstances may change very quickly in the next 3 to 6 months. But for now, Tom, this economy is not falling apart.
Did you see the allusion there that Brammo made to the Titanic? The band.
It was subtle.
It was subtle. It was very subtle, but there it is. Like,
very Brammo-esque.
It's very Brammo.
To go there. What
Brammo, she goes all Titanic on us.
What to talk about one sector, and it's not shipping, and it's not Leo and Kate. It is a Meta at more than 80% year to date. Just a phenomenal move. Mm-hmm. And it's not just the rate story and pricing in rate cuts. It's the cuts at Meta and Facebook. Is there any reason to get behind some of these tech names that have already moved so fast, so quickly, year to date?
Yeah, I mean, I think there are reasons. I mean, the valuation reason aside, the fact of the matter is tech is where most of the cuts have actually occurred. I mean, if you look at the earnings expectations for communication services and infotech, they're down 15% year over year earnings decline for Q1. And if you look at the revisions, they've been pretty drastic for those names as well. But then on the flip side, if you have the consumer that's not falling apart, then maybe that actually bodes well for digital spending, for digital ad spending. So that bodes well for things like Google and Meta, for example. So I do think there's actually some fundamental reasons. And then outside of that, if you look at kind of the enterprise spending and if you look at artificial intelligence, this is just early days, and this is just getting started for the likes of Microsoft and Google as well. So I do think there are reasons. And John, the last thing, if you think about who has the solid balance sheets, maybe it's some of the banks, but sure is also some of those tech companies, and they're probably the least interest rate sensitive of the bunch.
Job cuts at Meta, job cuts at Disney. We'll talk about those Disney job cuts a little bit later on this morning. Price cuts at Tesla. You and I used to talk about thematic stuff around EVs quite a lot, and there were single names to do that. You would talk about the whole supply chain years ago, Anastasia. Where does the EV story go from here? How do you feel about things now?
Well, I think EV story is absolutely evolving, but the issue in particular around the price cuts is it's not just Tesla that's manufacturing EVs. There's probably 400 or more different car manufacturers that are trying to do this globally. So it's a highly competitive environment. So when you think about what is the best way to position in electric vehicles, for example, it's those enabling technologies. It's the batteries. It's the battery storage. And, by the way, you're going to need that for electric vehicles. You're going to need that to stabilize the grid that's going to be powered by solar and wind. So that, to me, is how you kind of approach that. But, to be in a highly competitive car maker space, guess what, John? Everybody's going to be there. And, it's inevitable that prices have to fall in order to incentivize the consumers.
Before we let you go, Anastasia, I remember when you came on here and you talked about private markets and how there were still a lot of opportunities there, even as some valuations did decline. What's your take on the state of commercial real estate, given all of the focus on that really underpinning some of the stress to come in the financials?
Yeah, look, there's obviously a lot of well-talked about risks. There is $1 trillion in commercial real estate loan maturities coming up this year and next. And as scary as that sounds, I would say a couple of things. First of all, the underwriting standards this time around on commercial real estate loans have actually been a lot tighter and a lot better. So if during the financial crisis, the loan-to-value ratio was about 70%, recent loans have been underwritten at 52%, 56%. So that means that commercial real estate can decline by a whole lot more than 10 or 15%, which it did already before you eat through that equity buffer. So again, as scary as the wall of maturity sounds, I think there's some mitigating factors. But obviously, we do worry about things like office, where the vacancy rate is between 12 or 16%, depending on where you look. So I do suspect we'll see defaults there. But again, Lisa, commercial real estate prices have already adjusted by 15%. In the case of office, they've adjusted by 25%. So I suspect over the next few months, in the next coming quarters, I think this is actually an opportunistic environment for investors.
Well, Anastasia, bullish when many others weren't. Thank you. Thank you. That trade's turned out from earlier this month. That's for sure. Anastasia Amoroso there of iCapital, Tom. Still looking to break out from that very tight trading range through 4,200.
And maybe bonds can be an equity bull signal. Lisa, to review this, LVMH, they did a $1 billion short-term paper offer out, I think 2 years, 3 years. It was 2.7 times to 1 subscribed, and they were able to set the yield approximately 22 basis points, 0.22 percentage points below where they thought they'd have to be. That's a bull market.
Well,
that's stunning.
Well, as John was talking about, this is a very specific issue or two that hadn't come to market since the height of the pandemic in March 2020, and that was for an acquisition. But to the point that Anastasia is making, there still is plenty of demand, and perhaps fear of missing out on the part of buyers seems to be coming back to the fore.
That's an LVMH bull market. Let's be super clear about that.
It may be, but there's other companies out there. They got to go to the truck and load the boat on debt.
Yeah.
There's no question about it.
Just have to describe another luxury player.
Exactly.
Like
I mean,
exactly.
Anastasia's got she's got tons of Louis Vuitton.
You speaking for yourself?
No, I know Anastasia. She's got it's Louis Vuitton. That's what they.
Is that how you pronounce it?
Yeah.
Okay. Yeah. James Athey coming up.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be
than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
After the whole bank stress earlier this year, for me, recession odds increase and hard recession odds increase along with that.
If your economy is not in recession now, and it hasn't been in recession recently, it's got a 20% chance that it's going to have a recession in the next year.
The bond market's been pricing in recession for a long time now.
Everyone says this is going to be a shallow recession, and I find that statement to be more a function of comfort than analysis.
There is so much negative emotion in the market right now that really the only surprise it would be to the upside.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Crisis over. It's back to watching the Fed. John, the headlines here with all the big banks reporting and some of the selected regionals coming in is the Silicon Valley to the rest of banking America thing was a bit overplayed.
The good news is it's not terrible so far, but I keep going back. I might sound like a broken record, but I think this is important. There are two ways of viewing this. One, it was a one-off event. We can leave it in the past. Two, it was the start of a process that will lead to tighter financial conditions, tighter lending standards, and softer growth, and ultimately maybe fewer rate hikes to the Federal Reserve. I can tell you we're taking out some of those rate cuts that have been priced in over the last month. Citi's Andrew Hollandhorst has been so consistent about this over the last month. His view has not changed. He says this: a May 3rd 25 basis point hike is close to fully priced, and the market is beginning to afford more probability of another hike in June as well. Their base case and what they expect: 25 in May, 25 in June, 25 in July, and at the end of it all, Tom, a rate that is closer to 6 than it is to 5 by year end.
Dovetailing with that with strategy, moments ago, Ira Jersey, expert on the short-term paper market with Bloomberg Intelligence. John, I'll read the headline. Bond bulls, that's price up, yield down, better brace for a bumpy road ahead.
And we're seeing that this morning. Yields up, Lisa, by 7 basis points. The 2-year very close to 430 after breaking down towards the 350 kind of level over the last month or so.
Have stocks priced that in? Have stocks repriced the idea of a Fed risk back on the table? And I think that's one key question, especially as you see the NASDAQ once again underperform in the face of higher yields. But going forward, when is this good enough to give the all clear to the picture that we saw pre-March 8th? Or are we looking at the slow grind? We saw loan loss provisions increase. We saw deposits fall on the margins around a number of banks. Investment banking, lethargic going forward. These all are going to constrain things going forward.
Or are we back to studying inflation? How boring, how quaint. You look at the United Kingdom today, we haven't made enough about it.
Double digits.
Wow, those are sobering statistics.
Still north of 10. Look at Europe, still sticky.
Yeah.
The rate hike effort returns. There was I believe, Tom, I think that Governor Bailey may back away from rate hikes at the Bank of England, but after that data this morning, it's going to be tremendously difficult to make such a move.
Quote, he didn't want to declare victory, unquote, and he looks good in hindsight on that. I would suggest the clear message at the IMF meetings was a 5 or 4% inflation rate is just absolutely unacceptable. I mean,
you described the IMF, Tom. You know, what I witnessed at the IMF was just a bunch of people with their heads in the sand at the International Monetary Fund, just firmly in the sand, talking about pre-pandemic interest rates and these big 5-year views. After we've just seen,
that's part of their mandate.
After we've seen such a big development in the last month or so.
Is it head in the sand or head firmly in diplomacy and in certain kinds of politicking?
Probably that too, sure.
Well, because, I mean, I think about it, they had these sort of range of possible outcomes that could be very different from going back to those pre-pandemic norms. It's just that they were kind of subjugated down lower because it doesn't really matter. But you're right. I mean, there is this sort of feeling that the world has moved on and perhaps policymakers haven't caught up.
Pressure on Europe, the Eurozone, the ECB, the UK, the Bank of England, Tom, to do more.
Within the bull market that Anastasia Amoroso talked about, John, to get the data moving here, the VIX 17.51. The angst today feels like a VIX of 19 or 20. It's not where we are. Within a bull market, we're under 18.
Equities at the moment down about 0.6% on the S&P 500. If you are just tuning in, welcome to the program. Morgan Stanley out a little bit earlier. Some disappointment around certain issues, but on the big issues for this bank, wealth management doing okay, FIC trading doing okay. The stock just negative in the pre-market. Alongside what's happening in the equity market, down 0.6% on the S&P. There's that bond move for you. We talked about the front end of the curve. Yields up. Likewise on the long end, on a 10-year up 4 basis points, 361.57. And we're seeing off the back of that some dollar strength, Tom. Euro dollar down 1/3%, 109.32.
Yeah, we're going to want to say carefully for the pros. I'm looking at euro yen as a real global metric here. We have not broken out the strong euro weak yen. That will wait. Joining us now to piece this together is someone widely followed worldwide. He's with Aberdeen. James Athey joins us, their investment director. James, what are you going to write about this week? I mean, we've discovered here it's Wednesday. We got to get to Friday. What is the theme for you when you're writing, given the immense jumble of the moment we're in?
Hey, Tom. Well, that, to be honest, is the theme. that is exactly how I would think about what we're seeing in front of us. Is that the signal you're getting from looking at equity markets, looking at bond markets, it is very much jarring. It's very much a confused macro picture where bonds are probably priced for somewhere between bimodal outcomes in a world where both of those bimodal outcomes are bad for risk assets, because one is much higher rates, much more persistent inflation, and the other is much lower growth, and equities aren't priced for either of those two outcomes. So I think we're just continuing to see the fact that markets are not making sense when you look at the signals they're sending cross asset. And to be honest, a lot of that, you know, one of the clips that you played earlier was about the fact that sentiment is so weak that the only way is up. And if you look at things like the Bank of America Fund Manager Survey, you can draw the same conclusion. But I think we learned something about market structure and the extent to which a lot of investment decisions are not made based on fundamentals, but based on price triggers and vol triggers. And that's where a lot of this equity buying has come from.
James, every single day we're reassessing the probability of this banking shock turning into something worse in the economy. And we've really priced out those rate cuts more recently. If you take the 2-year, the pre-SVB high and the post-SVB low, the 2-year yield is somewhere right in the middle of that right now. The high north of 5%, the low close to 350. Right now, let's call it 420 something, James. So now comes the big call. Which direction do you want to lean in, James? The higher yields or lower ones again?
No, it's certainly lower, John. I think, we did overshoot because, of course, at the time of banks, going bust, essentially, the global financial crisis fears all come flooding back, and we wonder to what extent there's going to be a sort of domino rally of collapses. The reality was that there's a common trigger, which is obviously liquidity withdrawal, but there were specific vulnerabilities in those bank business models. But the Fed has already told us that tightening lending standards, in their opinion, will substitute for rate hikes. They don't quite know how many, but their best guess looks to be a couple, because those 2-year yield highs that you refer to above 5% came hot on the heels of Jerome Powell suggesting they may go back to hiking by 50 basis points. And where we were priced in the strip then versus where we're priced now suggests that it's very difficult for us to go back to thinking about 50 basis point hikes, a much higher terminal rate, until we have sufficient evidence telling us that bank lending standards are not going to tighten enough to substitute for those rate hikes. And that's obviously going to take time. And in that time, the current path of economic data suggests things will continue to slow.
How vulnerable does this make big tech?
I mean, big tech is infallible, isn't it? I keep hearing the wonderful pseudo-scientific analysis that goes on with big tech, whereby a strong economy is good for big tech because it's equities, and a weak economy is good for big tech because it's a duration proxy. It tends to be the case that those sort of pseudo-scientific hypotheses will get falsified at some stage, and stocks that we believed to be acyclical or counter-cyclical will turn out to be much more cyclical. But there's a certain element of a leap of faith or a fear of missing out, I think, when it comes to big tech. Ultimately, a recession is the test for all stocks, and I can't imagine that big tech will necessarily rally from these sort of valuations if indeed we do go into recession.
Forgive me for sounding a bit exhausted with the way that markets have been trading over the past couple of weeks, but I'm wondering how long you think we're going to remain in this churn where there really isn't a clear direction or narrative dominating anything, and really people have to do the work and go to the specific names and understand the companies and go back to an old-fashioned form of investing.
Yeah, I mean, I share your weariness, Lisa, to be honest. Again, a lot of that does relate to the fact that we'd had a very, very violent move. 2-year yield went from nearly 510 to nearly 350 in the space of a few trading sessions. And that was really pricing Fed cuts as soon as June or July. And that always, even for somebody who's been pretty bearish on the outlook for as long as I have, that always felt like an overshoot in the very short term. So just unwinding that is the kind of moves that we're seeing currently. It's a bigger test from this point on. We've just had a quiet data week, but of course, as we move through this month into next, we'll start to see more significant economic data points testing the market's resolve from all angles.
This year's been amazing. James earlier this year called it narrative table tennis, just back and forth from one thing to another. I keep going over that. Yeah. January was soft landing, February it was no landing, March it was hard landing, and April is like something in between.
All priced in.
Still trying to work it out. James, final question for you. Who have you got more faith in, the Federal Reserve or Spurs?
Right now, the Fed. If you'd have asked me the Bank of England or Spurs, that would have been a really, really difficult decision. As a long-suffering Spurs fan, you learn never to have faith in Spurs.
James, the Bournemouth Cherries tore them apart. What do you do when you got this gorgeous stadium? Help me here, John. Adele loves you. Emma loves you. I mean, everybody loves the Tots. And they're like the Toronto Maple Leafs. They're like built not to win.
They're just not getting it done. Just
for like, what, 20 years?
For a long time. James, what is it? Antonio Conte, the manager, complained about the culture of that football club. What is it?
Yeah, I mean, it does look like there's a psychological block, even when we had Maurizio Pochettino and we were all conquering. I used to go to games, and it didn't matter who we were playing, home or away. I would walk in thinking we're going to win when we had Pochettino as manager. And over the course of 2 seasons, we had more points, scored more goals, conceded less goals than anyone else in the league, and we managed to lose the league on both of those occasions. So it does feel like there's a psychological block at the club, but we need a new manager. That would be a good start.
Today, Bayern Munich, Manchester City, are they lobbying for Harry Kane? I mean, when does Harry Kane just say enough?
I think we might be close to that.
I'm serious.
This summer transfer window is important because he's getting to a certain age where You've got to make the call for your next 3 to 5 year contract.
I think this needs team coverage by Bloomberg Surveillance.
I think this is the extent of our team coverage. If Lisa is responsible, that was it. And it kind of went about 2 minutes over, didn't it? I can see around the corner of my eye.
She's doing her taxes. She filed for an extension. She's doing her taxes over there.
Do you think Lisa's the kind of person who files for extensions? Bramo's not an extension kind of woman. No, that doesn't surprise me. Futures down about 0.6 on the S&P. Matt Lazzetti at Deutsche Bank coming up shortly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Republicans will vote next week on a bill to raise a debt limit and impose new cuts to government spending. President Biden and other Democratic leaders are refusing to offer any concessions. Republicans are betting that if the House passes the bill, that can ramp up pressure on Democrats to consider compromises. The debt ceiling has to be raised or the U.S. runs a risk of a default. Another strong inflation reading is raising the likelihood for more interest rate hikes at the Bank of England. Britain's Consumer Prices Index rose 10.1% in March from a year ago, driven by the strongest increase in food prices in more than 4 decades. The pound edged higher, and UK government bonds sank after that report. Fox News has avoided a potentially embarrassing trial. The network agreed to pay $787.5 million to settle a voting machine maker's defamation lawsuit over its 2020 election broadcasts. The settlement was for less than half what Dominion had asked for, but was far above analyst estimates. Fox had aired bogus claims that Dominion rigged the vote against Donald Trump. Baker Hughes is forecasting decades of growth for natural gas demand. The world's 3rd largest oil field services provider posted the strongest first quarter sales since 2019. Baker Hughes says the world is seeing the crucial role that natural gas will have in the energy transition. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It's almost like people are determined to spend and spend on travel in particular. Even we're seeing our fares. Last year we saw fares rise by 14-15%. We think this summer, and I'm on record as saying, I think it'll be maybe, we might get to double digit again, maybe 10% increase in airfares.
Here we go again. That was Michael O'Leary, the Ryanair CEO, the European airline. Double-digit fare increases last year, maybe the same again this summer. I know we all can't wait, can we, TK?
Did he make a recession call? I don't think he did.
I didn't hear anything.
I did not hear that. He was like on the edge of James Bullard.
Boom time in Europe. He was talking about the invasion of American tourists onto European shores. Bramo.
I loved
it. Getting busy.
It was like kind of really nice, and it was also kind
At the
of
same time,
like,
it's an insult.
yeah, it was like, really? You guys are just basically an infestation.
Can we just like hand him Newark Airport and see what he would
and ask
do
him
with
to
it?
figure it out.
Figure it out. I mean,
LaGuardia is looking good, I have to say. Every time I get there,
this is
every
the future.
time I get there, I arrive and get to that terminal, see that beautiful view.
It's on
Queens
the edge of Zurich.
Manhattan. Just frame it. It's beautiful. Love that. Love it.
This city's fallen apart with infrastructure projects, including a tragic parking garage collapse yesterday. And LaGuardia is a symbol, John, of the future. That's the only way they're going to get it done.
Make it happen. JFK is just depressing.
Well,
JFK. Then you leave from Heathrow, and you're just like, whoa. What happened here?
Yeah, or name 10 other airports in Europe. I mean, Edinburgh.
Pick any international airport you like.
Yeah.
It just doesn't add up. Anyway, tons of Fed speak a little bit later. I'm sure they'll talk about the airlines.
With John Farrow.
Goolsby and Williams on tap, talking about JFK, Newark, and LaGuardia. Matt Lazzelli at Deutsche Bank doubts we'll hear much of any of that. And he doubts we'll hear much to sway expectations either. Our own forecast continues to see the Fed holding steady at 5.1% through year end before beginning to cut rates in January 2024. TK, that's the Lazzetti Deutsche Bank call. I have to say, not much daylight between that and a lot of what's been priced recently.
Yeah, I think what's interesting here is to frame it around the debate that's out there. And we've heard it this morning, even of sustained inflation like what's in the United Kingdom, all the way down to real talk about substantial disinflation, including goods deflation. Matthew Lazzetti joins us now with Deutsche Bank. And away from your arch recession call, you led on that among, I think, all of market economics. Your call for interest rates is like Richard Clare, as the former vice chair, writing in The Economist. No, we're not going to get back to 2%, not back to 1%. But what does our world look like with an inflation that gets back to 2.6, 3.2, that kind of level, the Clarida level?
Yeah, so I think that's closer to where we expect to be by the end of this year. We have core PC around 3.5%. That is a lot of progress from where we are today. I would agree with Governor Waller's comments recently that over the past year, you've basically seen very little progress, and we can point to different components that have moved back and forth. But the reality is we haven't seen much progress over the past year. I think getting back down to 3.5% for the Fed, that matters in the context of what the labor market looks like. So if you still have a 4% or below unemployment rate, you have a Fed where the Fed funds rate is probably higher, certainly not as cutting rates. But if that's occurring within the context of a recession where the unemployment rate has risen to 4.5% or 5%, which is the context that we expect, that'll be what triggers the Fed to be cutting rates.
And then to add that into your GDP call, do you have a diminished inflation, a disinflation, into a slowing real GDP level or quarter-to-quarter movement that gets us down to a new diminished nominal GDP?
We do. We have modestly positive growth in Q3. We have negative growth beginning in Q4 into the first half of next year.
Sub 4% nominal GDP?
It is. When you add in where inflation is, we only have 0.6% growth for this year. So it is sub 4% nominal GDP. But I think really for the Fed, it's the context of what is happening with the labor market. I think that's been the key area of debate. We've seen slowing there, but I think across most of the metrics, still 4 million more job openings than unemployed individuals. The private quits rate actually ticked up recently. The Atlanta Fed wage growth tracker hasn't shown any progress in coming down. I think that's really the crux for the Fed.
A lot of people lean on the projections coming from the Federal Reserve, the quarterly SCP, the summary of economic projections. There's not much daylight between your rates call and their rates call for this year. In fact, there's no daylight at all. Where is there some daylight between you and the Federal Reserve when you look at their outlook?
Yeah, I would note, I think they've come a little bit closer to us over time.
Yeah, I would say that too.
But at the moment, there is, for this year, very little daylight. There is greater daylight into 2024, and they have their path, which I think is this gradual cutting path under something that looks somewhat like a soft landing, even with the unemployment rate rising by 1 percentage point, and they're just kind of gliding back towards neutral. Our expectation is that they have to cut more aggressively, that you get a recession, the unemployment rate rises. We have 225 basis points of cuts between Q1 and Q3 of next year. There is, no doubt a gap between us and where the Fed is and the market at the moment by the end of the year, but that gap's been diminished. We're at a 4.6% or so Fed funds rate at the end of this year, And that seems quite reasonable to me within the context of, you might have a recession beginning in Q4.
Can you dovetail that idea of more aggressive rate cuts in 2024 with what we've heard from the banks just now, which was supposed to be really telling from an economic perspective? We would finally know how bad this credit crunch or credit kerfuffle or whatever you want to call it was. Now we're living in this sort of like, what did we learn? We're not sure. I mean, how much have you learned from this?
Yeah, I think not much yet. I think we're hearing from a lot of the larger banks, which were anticipated to be a beneficiary of some of the stress in the smaller and medium-sized banks. In terms of the Fed's H4 and H8 data, we've seen decreasing stress in the Fed's balance sheet, which I think has been a positive. It's giving us some sense that we're hopefully beyond the acute phase of what's been happening in the banking sector. But I think everybody's anticipating that we're still going to have this tightening of lending conditions, tightening of credit conditions that takes place that reduces growth. That is part of our baseline expectation. But at the moment, it's mostly scenario analysis. We really can't have a great idea of how much things are going to tighten. We'll get the Fed Senior Loan Officer survey in early May. I expect that's going to be quite negative, just given when that was occurring, kind of around the peak stress that we were seeing.
Going back to 2024 and your belief that the Fed's going to cut much more aggressively, what's the threshold? What's the bar going to be for them to be more aggressive with rate cuts?
Yeah, I think it's, are we seeing a recession take place? Their forecast for the unemployment rate is that it rises up to 4.6% and stays there. You don't ever really see that in a recession. These things are nonlinear. If it rises 50 basis points, you get a recession, it rises by at least 2 percentage points. And so I think if you have something that looks more like a typical recession, which is basically our forecast, you get a 2 percentage point rise in the unemployment rate, then I think we should expect that they will be cutting rates. I think they've been very clear they're not going to repeat the mistakes of the 1970s. The way that I would kind of view the mistakes of the 1970s were that they cut the real rate from very positive territory to very negative real territory very quickly. We don't expect them to do that this time around. They can cut rates pretty materially and still have a positive real Fed funds rate.
It's so unfair of me to ask this, but is that forecast a political forecast? Do you think there's a political element to it? To say 4.5 year end, 4.6, 4.6 next 2 years. How much, I'll phrase it differently because I know you don't want to answer this. How much political heat would they get if they were forecasting anything higher than 4.5% and described exactly what you think is going to play out?
Yeah, I don't know if it's as much politics as there's a confidence channel from how the Fed is forecasting things. And so they have a different role to play than I do. They can impact sentiment in the economy. They can impact, I think, overall confidence, and therefore can impact what the actual outcome for the economy is. And so I think, that should be viewed within that. Both their inflation forecast, but also what they're showing with the unemployment rate. It's notable, I think, nonetheless, that they're showing the unemployment rising as much as it has. It's notable that in the minutes, the Fed staff, very clearly has a baseline mild recession. These things don't happen very often from the Fed's perspective. So I think it is a commitment in showing that they are willing to take the necessary actions to get inflation down.
But Tom, it's almost Soros Popper-esque that you can shape the events you anticipate. It's almost something self-fulfilling about unemployment forecasts at the Federal Reserve.
One of the best conversations I ever had was with the younger George Soros talking about Karl Popper in the early 1950s at LSE. This is economic epistemology, religion, I say, at UCLA. And the idea is you get out front and then can you reframe things as you go along? That's the narrative's reframing, if you will.
Hey, Matt, this was smart. Always is. Matt Mazzetti there of Deutsche Bank.
I never thought we'd get there.
On a forecast.
Here we are.
At the Federal Reserve. Matt, thank you. In the next hour on Bloomberg TV, on the bond market, Subhadra Japa of SocGen, Gershon Distenfeld of Alliance Bernstein, on banks, Ken Leon of CFRA, and on everything, Jay Pawlowski of TPW Advisory. Jay's been super constructive on the financials, even through the mess in March, Tom. He's stuck with it.
Ask him about the Pacific Rim. He was way out front on China optimism.
And remains super constructive, Tom, across the board, worldwide. In fact, sees the rest of the world outperforming in a major way from a market's perspective. We'll talk about that. Futures on the S&P 500 this morning, -5 or 0.6%. Yields pushing higher by 5 basis points on a 10-year 362. On a 2-year yield, higher by 6 basis points. Very close to 430 a little bit earlier this morning. Your 2-year, 425.
seeds, typically between the time you start and they get out in the farmers' fields is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Surveillance. Good morning, everyone. Within banking season, the major banks out here, Morgan Stanley earlier, we're looking at some of the smaller banks moving into today and also into the coming days as well. Lisa Bramwitz and Tom Keene. John Farrell getting ready for a really interesting 9 a.m. Effort here. Within a day where the data is a little nudgier than it's been the last number of days. I note the VIX 17.36, futures negative 24, that's 0.6% down for SPX. Lisa, we haven't even talked about it. Second day, I think, in 3, where Bitcoin just loses the bid. I don't know what to make of it. I mean, I'm going to wait for crypto 5 days from now.
I'll let you do the Bitcoin analysis.
29,000.
I am curious about some of the earnings that we've gotten, and we've talked about some of the banks, Morgan Stanley among them, as well as some of the regional Citizens Financial, as well as U.S. Bancorp. But Ally Financial came out this morning, a little talked about.
Yeah, thank you.
This, to me, was quite interesting because this is the auto lending sector, and this is a question of the consumer credit impulse and whether there's any contraction. And there was. You saw actually fewer loan originations in the auto space than people were previously expecting. You have a sense that they are tightening their underwriting standards, with some consumers walking into dealerships, and listen to this anecdote, with $10,000 in negative equity, and others who are struggling to make payments on existing loans. This goes to the heart of auto pricing. This goes to the heart of whether people will continue to spend what they don't have if this kind of credit is being constrained.
I'm so glad you bring this up, but of course, this is the ex-GM finance wing, renamed Ally, A-L-L-Y, for those of you internationally. And what this goes back to is Olivier Blanchard talking about the Biden stimulus. And on the back end of that COVID stimulus, what did we do? Went out and bought a car.
Well, exactly.
That's what a lot of America did.
So perhaps people aren't running out of cash to buy airplane tickets, but are they running out of cash to buy new cars? Are they running out of cash for some of the bigger industrial goods?
And to maintain new cars.
Exactly, which is the reason why perhaps you've seen this bifurcation between services, still hot, and the industrial goods, which have seen a recession.
And to dovetail into this is a good conversation. We've had a number of them today, different views, but in the heart of it is Michelle Girard, head of U.S. markets at NatWest Markets, I should say. And Michelle, I love your note because you're very consumer-based, 70% of the economy. Lisa outlines some of these tensions are there. Is this the point where the consumer finally gives up the Biden stimulus and the boom?
Yeah, I think so much of what you were just talking about is where our concern lies. And it is around the potential for a credit crunch to really put a restraint on the consumer that we haven't seen. You know, as you said, since the crisis, the consumer was flush with cash. Then they had very high savings, and they've really been able to extend their spending long beyond, I think, what people had expected. The shock of sharply higher interest rates not really seeming to put much of a dent in demand. But I think when you now combine that with the credit crunch, and Lisa, as you pointed out, looking in the results that we're getting to try to see to what extent there is some bite in that. We're looking at the senior loan officer rate to see how much credit conditions are tightening. I mean, all of that we think will come together to put some real pressure on the consumer in a way that we haven't, and tip the economy into a recession later this year.
Miles away, folks, May 5th. Lisa, I don't think this is a good number yet. Change in non-farm payrolls, a survey is 175,000, which is below 200, below the convention we've seen during the COVID boom. And Michelle, what does that glide path do? I mean, David Kelly over at JP Morgan talks about a negative non-farm payroll statistic. Are we going to see that this year?
Yeah, well, that would be our forecast. We've got negative GDP growth in the second half of the year, a recession. And so, of course, alongside that, we'd expect to see negative payroll prints. We've got the unemployment rate rising a bit, like over a percentage point, getting to over 4.5 by the end of the year. So we do expect that you will see the strength of the labor market taper as the overall economy really begins to slow. And it really comes back to the impact really of the tightening in financial conditions, particularly now exacerbated by credit standards being tightened and the bite that will have on both businesses and the consumer. And in general, I think just more caution and optimism, particularly on the part of business now, given the environment is I think much more uncertain going forward.
Michelle, how do you push back against people who say with the auto sector, there's a lot of specific details that are, I don't want to use the I word, but let's use it, idiosyncratic to the auto sector, that you're seeing sort of a tightening after an incredible loosening there, and you're not seeing the same kind of pressures in the services sectors and some of the other spending facing kinds of areas. How do you push back and say it all will suffer heading into the end of the year as we see some of these tighter credit conditions bleed through?
Well, and that's exactly the point. I mean, autos may have some idiosyncratic issues, but autos and other kind of cyclical spending areas tend to be the early warning signs. That's where, trouble seems to first present itself, and very well may be the first area that we see issues now. And it is our expectation, particularly as we think about the economy worsening, businesses getting more cautious, hiring and labor demand, beginning to wane. All of that will feed through into a broadening out of the weaker spending patterns that are now evident in just some specific areas. And so, that is the point. Is that yes, at the moment it looks fairly narrowly focused, but that's often how these things start, and then they broaden out. And the trends that we're seeing, as I said, some of the leading indicators about where business spending and activity and so forth are going that precede broader demand changes, that's the stuff that we're watching and signals to us some much more headwinds ahead.
Will those headwinds be enough to bring inflation to where the Fed wants?
Yeah, I mean, that's been, we've been really skeptical about inflation being able to get back to 2%. But now I think with even more confidence that the economy is going to, be weaker because of these headwinds, I think we do feel that the odds of the inflation rate, getting back to 2% without the Fed having to take rates as high as we had anticipated, we're more confident about that. We don't have inflation getting back to target until 2024, but we also have taken off some of the expectations for Fed rate hikes that we have. We think the Fed is done. I mean, may they go again in May? I guess possibly. We're not dug in about that, but essentially we're sort of at the peak in rates, and we've actually got the Fed, cutting rates into 2024.
Michelle, bring that over to the yield market, to where we actually price all this mumbo jumbo. There is a narrative that we're hearing, not from all, but from some, that yield comes in from here, 10-year yield comes in 3%, dare I say under 3% as well. I would suggest most of our audience on radio and television doesn't believe that. Are you setting us up for a 2.95% 10-year yield?
We don't have yields going quite that low that fast, in part because you do have inflation that is still going to remain sort of stubbornly high, and also in the sense that it won't really fall below. I think we've got it at the end of the year at 3%. It won't get towards target. It won't put the Fed in a position to be able to lower rates until later in the year. And I think that provides, I think it slows the speed at which you can actually see yields move dramatically lower. And so, that is the trend that we see. But I think the pace of all of that unfolding may take longer than some expect.
Michelle, it sounds like you're conservatively positioned, and I'm curious how painful it's been over the past couple of weeks as basically markets shrug off a lot of the gloom and doom and manage to rally.
It's, as we know in the economics, field, I mean, you've got a whole host of data that can tell a bunch of different stories. And the bottom line is that no one can really be confident, the Fed included, about exactly what the path will be, what other events may, get thrown in to alter expectations. And so, I mean, I think in general, I understand the resilience, because if we're talking about the Fed having to do less, if we're more open to inflation coming down closer to target with the Fed doing less, perhaps a stage set for, a path where the Fed can cut rates sooner. I understand that there's some relief that goes along with that can provide, some support. But when the data do start to, I think, more uniformly suggest that the economy is going to be in for, some struggles, then the question about market pricing and do market prices accurately reflect underlying economic fundamentals will be tested.
Michelle, thank you so much. Michelle Girard with us with NatWest Markets here this morning. Lisa, I think we've got to encapsulate some of these narratives. And there's one narrative that the Fed will raise rates and then they'll raise rates some more. And I guess that narrative is inflation sticky, yields stay higher. We have a 7% mortgage rate. I'm trying to sum together the jumble. And they'll say that leads to recession. And then the other narrative is completely opposite. We've heard this from our guests this morning. Rates come in, inflation comes in. I guess the mortgage rates come down, and the outcome's the same. We still have a recession. That's sort of what I'm hearing.
Well, the question is just what are we going back to in terms of the new real rate of inflation? And I think that that's really the question that a lot of people have, with Dan Greenhouse saying that the resilience we've seen in the economy suggests something higher than we've seen pre-pandemic, and with others, including the IMF, saying that we're going back there. I do want to give you just some color from the first quarter earnings call with Morgan Stanley, with James Gorman coming out and saying he doesn't believe we're in a credit crisis or banking crisis, but he does think that a few banks may be in trouble. He said this is nothing like 2008. It seems like the earnings have confirmed that. So then what is the analog to this moment? And I think that that's what people are struggling with and trying to read through what this means for credit formation in the United States. And that's the reason why I think Ally Financial is so interesting, because it hints at the others. It hints at the non-behemoths that can really have a lot more discretion with who they cater to people who have to actually restrain some of their credit extension because of what they're seeing in the delinquency rates and in the charge-offs.
I go to the BTMM screen to look at the challenges here with that Goldman Sachs Apple interest rate of 4.15%. I don't know what the different parts of Morgan Stanley's doing, but I'm looking at a 5.16% 3-month T-bill. I'm looking at LIBOR setting 5.26 today, which is right up buttressed against recent highs as well. And at some point, it's got to give. They've got to start paying more for deposits. And, I wondered, can they make it to this weekend without doing that? And then it calms down.
Well, Morgan Stanley actually said that they did report fewer deposits than some expected. Although, in general, the stickiness of these deposits has been amazing.
Well, you give out a toaster, that's what you get. We're going to come back. We've got some really interesting things to talk about. Lisa Bramwitz and Tom Keene here. Futures negative 25. Dow futures negative 110. I did that for John Farrell. The VIX 17.35. On radio, on television, Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Fox News will pay $787.5 million to avoid what could have been an extremely embarrassing trial. Fox agreed to settle a defamation lawsuit by Dominion Voting Systems over the network's 2020 election broadcast. Dominion says Fox defamed it by airing claims it rigged the vote. Evidence showed that Fox executives and the stars derided the conspiracy theory, even as they promoted it. It's official. India is now the most populous nation in the world. According to the United Nations, India's population is now almost 1.43 billion, edging out China. The increase will put more pressure on India's Prime Minister, Narendra Modi's government, to create jobs. There's another sign that Tesla CEO Elon Musk is willing to sacrifice profits to boost demand. The electric car maker cut the price of its long-range Model Y SUV by more than 5% to just under $50,000. The cost of the Model 3 fell 4.7% to just under $40,000. Tesla reports first quarter earnings today. And mortgage rates in the U.S. rose last week by the most in 2 months. According to the Mortgage Bankers Association, the contract rate on a 30-year fixed loan rose 13 basis points to 6.43%. Meanwhile, the group's index of mortgage applications fell 10%. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet. Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We have to remember that the Federal Reserve is implementing quantitative tightening with the intention of reducing deposits out of the banking system after they created over $3 trillion under QE. So the entire banking system is going to see their deposits shrink. And the real question is the mix of your deposits. And the regional banks and the big money center banks, as well as Morgan Stanley, have good core consumer deposits, which are critical.
Gerard Cassidy speaking earlier to Global Wall Street with RBC Capital Markets. John Farrow with Ken Leon here in the next hour. Must listen and watch for all of you of Global Wall Street. This really interesting moment for banking in America. I've got a deterioration in futures in the last number of minutes. Futures negative 25 to negative 28. And NASDAQ down now 0.9% as well. So a bit of a pullback after the festivities of the last number of days. What I learned in a panel late Friday at the International Monetary Fund meetings was that anybody with the IMF that mentioned China, don't mention China, probably would be shown the door at the IMF. It was the great unspoken word at the IMF meetings. Joining us now is our Assistant Deputy Managing Director of International Emerging Markets and saying the China word. How did President Trump say China? China. However he said, I can't do the imitation. Lisa's better at it than I am. Damian Sassower joins us. Let's start with a why. Why don't they want to mention China?
Well, it's not the economic reopening. It's really geopolitical uncertainty that goes hand in hand with the fact that the U.S. and China really just don't have a dialogue, really a working dialogue today. And I think that's been, an overriding concern from some time now, but it really reached an apex, I think, over the past week. And I think it's spread out into a number of different issues. The fact that China has a managed currency and what that's doing for central banks across the Southeast Asian complex. It's doing good things, by the way. But in the same breath, look at Taiwan and look where we are. And Taiwan, as Lisa and I were just talking about, Taiwan export orders tomorrow is such a big number for the tech sector, for global equities, for the Southeast Asian bloc, for quite frankly the globe writ large, because it's going to tell us the extent to which China can really grow through the second half of this year. We know it's going to grow fast through the first half, the second half, all bets are off.
Which Pacific Rim complex or country has seen price down, yield up, where you can take advantage of the stress?
Well, they've all seen yield up, but not nearly as much as other regions. Eastern Europe and LATAM, talk about yield up on a nominal basis.
The Bolivia chart, Lisa?
No, but just Brazil, Mexico. I'm talking the investable ones, Poland, Hungary. Their yields are, and certainly on a inflation-adjusted basis, Latin America looks a heck of a lot more attractive than Eastern Europe. But going back to Asia, because the yuan is a managed currency, the central banks haven't had to move as quickly. Their currencies, by them not hiking, their currencies haven't gotten beaten down versus the dollar nearly as bad as those other regions. And so they're at an inherent advantage, and they can manage their economic growth a little bit better.
I want to sit on what we get from Taiwan tomorrow, especially given the fact that we get the Taiwan Semiconductor Manufacturing Company reporting earnings tomorrow as well. How indicative this is of a recovery that China is putting out there in the official numbers that isn't being borne out in international trade?
Right. So China on a quarterly basis is probably going to do 10% in the first quarter. Let's call it, another 6% in the second quarter, but then 3-4, we don't know. And a lot of that is predicated on the revival domestically and domestic consumption. For that growth to extend abroad and to extend through the full year, you need to see trade pick up. You need to see exports pick up. You need to see machinery orders, semiconductor orders all pick up, and we just haven't seen evidence of that yet. South Korea, Japan, and now Taiwan. And Taiwan really is the apex of that, as you rightly point out, Lisa. Taiwan Semiconductor has a virtual monopoly on semiconductors, and so we really need to see a turnaround there for us to get, I guess, any sort of bullish, risk-on sentiment with regard to the high beta asset classes like commodities and equities.
When you come in the morning, that's where I was going to go. How closely do you watch, for example, the response in the commodity complex to the numbers that we got out of China? People saying, look, the numbers beat, they're going to do great. You're going to see an upgrade to the potential full-year GDP. And then commodities fell out of bed.
Yeah.
How does this make sense?
Well, I'll tell you, forget about what it is. Let's talk about what it means. What it means for emerging markets is something quite different than what it means for us here in the U.S. because food and energy are such a bigger component of inflation in these economies that by that being held lower because commodities are coming off, it's actually giving them the ability to perhaps cut rates that much more quickly when and if the Fed actually pauses,
Right.
certainly more than the developed market complex. And I expect that to happen probably in Latin America first.
I have a chart of Argentina, which I can truly say is an absolutely original chart. I was talking to some of the leaders of the IMF of it. Dollar peso, and then overlaid on it, and this is on a log y-axis, the percent change of the black market blue dollar peso.
Yep.
And the statement is, we've never been here. The IMF has put a cajillion dollars into Argentina.
44 billion, yeah.
It's like a tuition payment to the University of Miami. It's that big.
Yeah.
And the answer here that you know about, and the answer here is, when do we say enough to Argentina?
We can't. I mean, the IMF
What do you mean by
its
that?
balance sheet is really locked into what they've done with Argentina. And even when Guzman left and Gidegolpin is now working at the IMF, is now working very closely, there's an election coming up. There's a lot of uncertainty there. But you're right. The blue chips, the parallel rate, as they call it, in Argentina, since Fernandez and the new regimes come in, it's traded about double that of the official dollar peso rate. And that really hasn't changed. So I think we're trading at 460,
400, yeah,
something crazy
400-ish.
relative to 200 on the official rate. You just can't really invest in that country. It's funny, I was having this conversation yesterday. Somebody was down in Miami, actually. The Argentine diaspora is huge in Miami, and they all come up during the winter months. They get their dollars, they work, they do what they have to do, and then they all go back in the summer months and spend their dollars. So it's actually quite interesting. Look, Argentina's muddling by. The elections are front and center in October. That's going to be the next point for us to determine just what we're going to do with this $44 billion that keeps getting restructured.
We're talking about emerging markets around the world with Damian Sassower, and the reason why a lot of people are paying such close attention is because so many people have been saying this is the area that's going to outperform the U.S. Yes. It's going to outperform the developed markets in the year ahead, even though we could see some sort of downturn. Do you think that the facts edify that view?
Well, I think you have to talk about and FX, because EM credit's going to follow corporate credit in the U.S., and I think there's spread risk there. EM equities, it's not even talked about. So we're talking rates and FX, and if we're talking rates and FX, as I pointed out, when the Fed pauses, all of the rest of the world is going to rush to price in cuts in Brazil and Hungary and all these guys who are first movers, et cetera. So from a rates perspective, you're going to get that duration gain if it's not already been priced in. But the FX, the dollar story, is front and center. And look, I have long been one to never bet against King Dollar. But, you know, what we're seeing, at least in the price action here, is, yeah, there might be some more runway for dollar weakness. And you see a lot of these currencies, specifically the Mexican peso, some of those who are maybe a little bit closer to, you know, to the dollar, I mean, really decoupling from it, right? And so it's going to be interesting to see just how long this dollar weakness can hold up.
I mean, peso, folks, 4 or 5 years ago was 21, 22. Strong peso through 18, and yet we frame Mexico's terrible. How do you get a strong peso if we have this generalized statement, Mexico's terrible?
Yeah, I mean, well, look, here's what's interesting, and I had this conversation with, you know, a mutual friend of ours yesterday, Tom. Emerging markets, the name emerging markets, how can we call many of these markets, like, for example, Brazil, emerging when their per capita GDP hasn't budged in 10, 12 years?
That's the heart of the matter, isn't it?
So, you know, when you think of Mexico, Mexico's more North America. It's not emerging market, you know, and you think of, I mean, if you want to tell me which markets have really emerged in the last decade, South Korea definitely, Poland, of course.
Right.
Now,
well, it was wonderful speaking with the governor of the Bank of South Korea at the IMF meetings. But this is really important insight for Mr. Sassower, folks. This idea of EM is not homogenous; that there's shades of it, including those successful. Damian Sassower with us with Bloomberg Intelligence, brilliant there. It's spanning the globe with Damian Sassower.
Well, it's linking in the trade data that we get to this idea of what we're seeing in some of these other markets, and this idea that if you don't get a commodity boom from a China reopening, well, that suddenly gives a green light to rate cuts in these other markets. It kind of shows the interconnectedness.
We're going to move on here with a nice summary of the day, but I want to first apologize to everyone. Somebody said in, are you okay? And I said, yeah, well, I came in, you know, as you know, Lisa, everyone has this plague in this cold spring that we have. And I've got my transfusion, I've got an IV of Tang, and, you know, things are going, you know, I'm going to just go home and go to bed, and hopefully it'll be better tomorrow. That's what we're all doing. You know,
I hope you feel better, Tom.
It's just like, you know, it's I got it, and other people in the team have it, and we're just, you know, we're fighting our way through it. Lisa, what's your thought here today as we wait for other bank earnings?
That we're not learning that much from bank earnings, and as frankly, other than we haven't really seen a massive crisis emerge. What I am curious about is when we start to shift focus to the other earnings that come out. Taiwan Semiconductor Manufacturing Company, for example, which we were just talking about with Damian. What we get in terms of the ongoing demand for some of these items that really have fallen off in the past few quarters.
What I'm looking at, Bloomberg Financial Conditions Index, a really good series used by the IMF. It shows accommodation 0.30 standard deviations. All you need to know is that means May 3rd, Jerome Powell will get to work. Futures negative 26. Stay with us on radio, on television. This is Bloomberg Surveillance.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Live from New York City this morning. Good morning, good morning. Wrapping up banking season for the big banks on Wall Street, for earnings season at least, and then on to the regionals a little bit later. Equity futures down about 6 or 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, Morgan Stanley wrapping up earnings on Wall Street as Western Alliance offers some hope for the regionals. Fed officials continue to push back against rate cuts. We begin with the big issue. Is the coast clear?
The large banks had a great quarter. I had to double check my numbers. Very, very good. Because the revenue beat is amazing.
The regional banks are already seeing deposit inflows.
We're seeing better earnings.
I'm not, in the gloom and doom camp on this earnings season. You've got very good earnings and you've got very good numbers. We're really just baking in this very onerous 2023 earnings picture.
You've had, the benefit of interest rates moving up.
I don't think we're completely out of the woods yet.
Things have started to look a little bit better than some analysts expect.
But it was all against expectations.
We'll hear much more from some of those smaller mid-sized banks this week.
Team coverage begins right now with Bloomberg's Sonali Vasek here in New York alongside Alison Williams. Alison, first to you. JP Morgan, decent, better than good. Bank of America, Citi, Wells, all the same. Look at Morgan Stanley this morning, down about 4% in the pre-market. What's gone wrong there?
Well, equities trading really is much more important to Morgan Stanley than the other banks, and that was a disappointment this quarter. Actually, across the board, the banks missed on equities trading, and we saw declines except for Goldman Sachs. The offset was better than expected fix. Again, Goldman Sachs an outlier there where they missed. And fees still weak, coming in a little weaker than expected. At Morgan Stanley, the other thing is wealth flows coming in a little bit light. That's a very important business for the bank. And then deposits, that's a big focus this quarter, especially net interest income. For Morgan Stanley, it was a touch light, and we expect to see moderation. And the cost of deposits, especially for Morgan Stanley, because the wealth business does tend to be much more price sensitive, those deposits going up pretty sizably.
Alison, did James Gorman give us much of an outlook at all?
I mean, nothing beyond, I guess, what we would expect in terms of the fact that they just said on the call that net interest income is going to be moderating. Again, that's not a surprise. We expect that across the banks. You mentioned JP Morgan earlier. They really had the big blowout number in net interest income quarter, and the expectations, I think, they're moving up for everybody else. modest beats, and in general, looking for a slowing of net interest income. The other thing that we're hearing a lot of the banks talking about is the investment banking outlook. Those fees, as I said, came in a little bit better, but they're still down 20 to 25%. They were cut in half last year. There's more and more talk about the second half seeing some kind of revival, but that's really predicated on the Fed cutting. And again, a lot of uncertainty around that.
Morgan Stanley right now down by more than 4% in the pre-market. The word that Morgan Stanley used for the investment banking division, investment banking more broadly, constrained. The word of the moment for the regionals, stability, maybe. Western Alliance, even more than that. That stock is flying in early trading. Shanali by 22%.
Yeah, check it out. You have profit that beat estimates. You have deposits stabilizing. This was a bank that was poorly beaten in the market today. And guess what, John? It's driving up the other banks today, too, in the pre-market. If you take a look at PacWest as well, you have the stock rising pre-market. This is a bank that has not yet reported, but was recently cut to junk by Fitch. I also want to point out U.S. Bancorp, which had reported as well. This is the largest regional bank, and you are seeing deposits rise as people have flocked to safety. So stability among some of the firms that we were concerned about, as well as some gains over here at the larger end of the regional banking system. The other interesting thing about Western Alliance is surgical asset sales. Whether it's Western Alliance or Goldman Sachs, are able to offload some things on their books to other people. Where those assets go is an interesting question, and whether we'll be seeing more deals like that. I want to point out some of the bad news in the market as well. We have Ally Financial down a bit as profit missed estimates. Remember, Americans are falling behind on car payments at the fastest rate since 2009. And this is a steady reminder here that not only is net interest income under pressure, but also certain parts of the loan market are really starting to show some real cracks. Now, how long those cracks show for is the question. According to James Gorman, this is not a banking crisis. That doesn't mean the banks aren't experiencing some significant worries. But again, he says to expect some volatility ahead for the coming months as the market works its way through this stuff.
Hey, Shanali, wonderful work as always, alongside Alison Williams. To the two of you, thank you. Joining us now, I'm pleased to say, Subhadra Rajappa, Gersten Distenfeld, Subhadra Rajappa of SocGen, Gersten, of course, of AllianceBernstein. Guys, I want to start with this quote from Citi, if I can, with one question in mind. Was the events of the last month a one-off event that we can just leave behind, or the beginning of a process? And this is what Andrews had to say consistently over at Citi. He said this last week: the stresses we're seeing in the banking system, rapidly contained, they've now faded. If the labour market stays resilient and inflation stays persistent, as they do in our forecast, the Fed is likely to hike not only in May, but again in June and July. Risks are two-sided, but we maintain our modal expectation for a terminal policy range of 550 to 575. So let's start with that question, Subhadra. Do you think the events of the last month are a one-off that we can leave behind, or the beginning of a process that leads to tighter financial conditions, tighter lending standards?
I think this is definitely the beginning of a process, right? This is exactly what you should expect at the end of the cycle. As the Fed raises rates aggressively, something breaks. Yes, the regional banking crisis has definitely meaningfully abated. You're seeing deposit outflows start to stabilize a little bit. You're also seeing bank earnings, where less bad news is good. And broadly speaking, we can look past the last month and a half of events, but we're always looking towards what the next shoe to drop will be. I mean, you're looking at mortgage rates starting to be at nearly the highest level in nearly 2 months. The commercial real estate sector is still, having issues and could have issues going forward. So we're just watching to see what else could potentially come under pressure. Also, credit conditions, broadly speaking, are tightening because regional banks, even though they're stable, might not be making as many loans. C&I loans are going to decline. So we're looking towards what the ramifications will be for tighter credit conditions on the broader markets.
Gersten, how would you frame things right now?
Well, I think the answer to your question, John, initially is both. I think they're both idiosyncratic in that there are reasons SVB, CS, banks in general. I think Subhadra just said, when the Fed raises rates, things break. But I think the answer is also that it's just a continuation of the real pickle the Fed is in here. If we're going to see tighter lending standards, more banking turmoil, right, that requires lower rates and more liquidity. And fighting inflation, which is still too high, requires the exact opposite. So the Fed's in a real bind, and it's not just the banking sector. We know that Fed policy acts with a lag. we're going to be seeing slower growth. We're going to be seeing weakness. And the question on the table, and everyone's trying to predict exactly what the Fed's going to do. The Fed's not sure what they're going to do here because they're in a real bind.
Right now, this bond market's somewhere in between. So if you take the high and the low of the last month or so, the last 6 weeks, you go pre-SVB, the high on the 2-year pre-SVB, north of 5%. The low post-SVB was in the 350s. And right now, we're somewhere in between, around 420, 430. And so, Badra, we've got a decision to make. Either we go back to pre-SVB or we dance around these levels and start moving lower. I noticed from your notes, your research, Badra, you think the market pricing of rate cuts seems a bit premature, but ultimately you have a bias towards lower yields still. Is that right?
Yes. I mean, our bias for yields for this year is gradual decline in yields. We still feel like 10-year yields have sort of peaked around 4%. The run-up in yields last month reflected a very aggressive policy path. Now we seem to be coalescing again towards the 5 to 5.25% as being the terminal Fed funds rate, which is really where we had it penciled in. And for rates to remain stable for the remainder of the year, that's really where I see the dichotomy between our views and the market, because the market's starting to price in cuts as early as, I'd say, November of this year. So I think in an environment where the labor market's relatively strong and inflation is sticky, the Fed is probably going to keep policy stable for the remainder of the year, not deliver cuts unless we see some sort of a financial stability issue like we saw earlier on this year, or if there's a meaningful slowdown and inflation's actually starting to come down meaningfully, and then that requires a little bit of an adjustment in the policy path. But as of now, I feel like the market's prematurely pricing in for cuts in the second half of this year.
Well, right now, Gershon, at the moment, we're talking up recession prospects and rate cuts. At the same time, we're seeing tighter spreads in the credit market. Gershon, you've been out front about how strong, resilient you think parts of credit actually are. I just wonder where you are now on high-yield credit.
Not much of a change. I mean, the daily gyrations in the market don't really impact things all that much. I think the starting point matters. Our credit conditions, our credit metrics going to get worse over the next few months? Yeah, probably. Our default's going to go up? Yes. But a lot of that is priced in already. And the real dichotomy between the markets is between the equity markets and the credit market. You know, the VIX dipped below 17. I think it was yesterday or the day before. High-yield spreads should be a lot tighter given that. The equity markets are, again, saying that things are much clearer. But, John, if I could just jump back for 1 second. Sure. This idea of what priced into markets. It's a pet peeve of mine. We say the market's pricing in something for two reasons. One, it's 18 months ago, the market was pricing in like 1 or 2 hikes, and we've had like a zillion. But more to the point, when we say that we're pricing in 2 to 3 cuts right now, that is really not accurate. What I think the market is telling you is that base case, call it 80% plus, the Fed's going to keep rates high for a long time and is not going to cut. But there's this, call it 15, 20% probability that things just get really, really bad and the Fed's going to have to cut 200-300 basis points. This 2-3 cuts is really an average of very different scenarios that could play out, and no one really knows, including the Fed.
So Neil Dunter of Renmac has said the same thing, Gershon. I think you make a very valid point. He's basically saying there's no in-between. And there is no in-between in reality. They're either going to have to cut and cut a lot or not cut at all. Is Gershon that essentially what you have to say on this matter?
Yeah, that's exactly the case. I mean, look, there's not zero probability they just cut a little bit, but yeah, it's these forces that we're talking about. The difference in what the bond market and the equity market is saying, the tension between growth and inflation. We're going to have to see how that plays out. And yes, the Fed has been very clear. They don't want to repeat the 1970s. They don't want to cut too early. But at some point, the damage could be so great that they're going to have to cut and cut hard.
So, Badra, final word on that, please.
I completely agree with Gershon. The market's pricing in a probability, not just of one scenario, but a variety of scenarios. And the tails are quite different between the Fed, hiking perhaps more than what the market's expecting, as well as cutting a lot more than what the market's expecting. If you look at past rate cut cycles, if for some reason the recession window gets pulled in forward, the Fed's not going to be cutting by 25 basis points. They're going to be cutting a little bit more aggressively if inflation starts to come down. So that's distribution of probabilities is what the market's pricing in. So I completely agree with Gershon. You shouldn't be reading too much of the market pricing hikes or cuts.
Or to Fed projections for that matter as well. We talk a lot about the median dot and one more rate hike. I just pulled up the range of the SCP. The range for next year from Fed members, Fed officials, is anywhere from 3.4% to 5.6%, which kind of speaks to what you guys are talking about right now. So Badra Gershon, going to be sticking with us. Going into the opening bell, about 18 minutes away. Equity futures are negative by 0.5%. Abby has some of the movers for you. Hey, Abby.
Hey, John. Well, we have a real divergence here between the big banks and the regional banks. One that we haven't seen for quite some time, specifically Morgan Stanley, is lower. This, of course, after on the surface, the quarter looks okay, but credit losses surging and profits declining on a year-over-year basis. Western Alliance absolutely surging. Balance sheet relief. Deposits rose $2 billion this month through April 14th. So those crisis fears cooling. As for Netflix, shares are lower but well off the post-market lows. Subscribers miss coming in below 2 million. The outlook is light, but investors encouraged by passwords. Tesla, prices are going down again. And then to round out the risk-off outlook, John, Riot Platforms and blockchain, crypto, that space is lower, perhaps suggesting again that the risk tone today, not so great.
Abby, thank you. Futures lower too by 0.5% on the S&P. Coming up, gearing up for more layoffs.
The last shoe to drop really is the jobs market and the unemployment picture. And you would expect that as the recession really starts to bite, that's when the layoffs start to happen.
More on that still ahead.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We've got negative GDP growth in the second half of the year, a recession. And so, of course, alongside that, we'd expect to see negative payroll prints. We've got the unemployment rate rising a bit, like over a percentage point, getting to over 4.5 by the end of the year. So we do expect that you will see the strength of the labor market taper as the overall economy really begins to slow.
Corporations across America have made the announcements. Now they're starting to make the cuts. Meta is set to begin company-wide layoffs today. In a memo seen by Bloomberg, teams from Facebook, WhatsApp, Instagram, and Reality Labs are set to shrink, followed by another round of cuts in May. Disney also given the green light. The company's set to shed thousands of jobs as early as next week, with its entertainment division alone looking at a 15% reduction. In the end, the cost-cutting push from Meta and Disney will slash a total of 17,000 jobs. Mike McKee has more. Morning, Mike.
Good morning, John. Well, as Michelle Girard said, we are looking for signs of recession in all of these job cut announcements and all of these job cuts. And in a way, they're a little worse than you anticipated because while Meta is cutting 10,000 jobs now, they already cut 11,000 in November. And as you pointed out, it's across the board. Disney losing up to 7,000 jobs across the board. Now, why is this happening? Is it because the Fed has tightened interest rates? Is it because we're seeing the economy slow down? It's kind of hard to tell at this point. You can see here the number of companies that have laid off people, and that's not quite showing up in all the data yet. Take a look at what's going on with Meta. Their number of employees has risen steadily, but all of a sudden, advertising revenue dropping off there. Are they cutting, and that red line is where they're going to cut to, are they cutting jobs because they're not getting the revenue? Or because they're preparing for recession, or is it a little bit of both? That's the question that'll be before the Fed. If you don't work at Meta or Disney, you're probably more concerned with what Fed interest rates are going to do. And jobless claims are still very low, even though they've gone up. Unemployment at 3.5%. One reason is laid off employees can't get benefits if they're getting severance. They also get 60 days notice of a layoff. Now, those are starting to expire, and we're starting to see these layoffs. But there's still a lot of open jobs. You look at leisure and hospitality. This isn't going to help the people at Meta, but they're still 2% below where they were before the pandemic. So there are jobs out there. The Fed thinks people can get new jobs. Is it going to lead us to recession or higher interest rates?
Mike, can I just ask you about claims just briefly?
Yeah.
We started to see that breakout a little bit recently. How do you explain that?
The biggest thing was they changed the seasonal adjustment factors that moved it up. We've seen in the last couple of weeks some slight moves beyond the seasonal adjustment changes. The question is, does that continue, and does it start to accelerate? Because a lot of these people who were getting severance are going to fall out of that, and then they will be eligible for benefits. That's the question for the markets, and we'll be here at 8:30 tomorrow to get the jobless claims numbers for you.
I look forward to covering that with you, Mike. Thank you, as always, Mike McKee. So, Badger, I want to come back to you on Fed forecasts, market pricing. We were talking about rates. Can we talk about unemployment too? So they've got this very smooth path, kind of jump up to 4.5% unemployment, and then you stay there, 4.6, 4.6 over the next couple of years. Can I just ask you what you think about that projection from the Fed for unemployment?
Well, one, they might not have as much visibility into the employment picture several years into their forecasts. And second of all, I mean, the SEP is always tricky because they don't really want to, they won't be able to really show any sort of a dire scenario because policy is supposed to adjust to account for any sort of displacements in the job market. I mean, price stability is part of their mandate. So the forecasts are not really going to reflect a very sharp rise in the unemployment rate, so to say. Our view on employment, broadly speaking, is that it might not, the unemployment rate might not go up to 4.5% by the end of the year, which is what the Fed has forecast. The labor market is still extraordinarily strong. The layoffs are very much in the tech sector. The tech sector is not the majority of the job market, and like Mike pointed out, the services sector is still trying to add jobs, and there's not enough people that they can find. So broadly speaking, to us, the labor market is probably a lot more robust than what the Fed has penciled in for the end of this year.
So where does that leave the equity market? Equity futures right now down 0.6%. All this talk of recession, this old phrase that gets thrown around on Wall Street, equity markets bottom before the end of a recession, not before the start of one. Marko Kolanovic of JP Morgan pushing that one forward again earlier this week. How does the credit market typically respond to things like this, Gershon? We're often told that credit leads, the spreads widen, going to economic difficulty, and as you've pointed out, spreads have been tightening.
I think credit markets are just behaving very differently this time, but for good reason. You know, this will be, I hate to use the word recession, John. You know, if we're going into a recession, a downturn, this will be the first time on record of like 50 years of data that we have, where in the preceding couple of years, companies did not take leveraging transactions. They didn't buy back a lot of shares, didn't make acquisitions, didn't ramp up capital expenditures. They were actually turning out debt and paying down debt. And it's not because companies have gotten religion on how to operate better. It's very simply we had COVID. And it's hard to remember now, but 3 years ago, we were sitting here saying the markets could have another 2008 outcome. So companies took that approach. They were very, very conservative. So you're looking at a much higher credit quality market. You look at the high yield market today, versus 5-7 years ago, many, many more double Bs, many fewer triple Cs. So just looking at raw spreads doesn't tell you the whole story.
It's different this time, Gershon? Are you basically saying it's different this time?
You know me, John. I'll never say it's different this time. There's a lot of similarities, but there are differences that we need to take into account. And you can't, something as complex as the overall credit markets and rate markets and equity markets, it's very hard to distill it down to just simple talking points around that. To me, the much bigger anomaly today is in the equity markets. As I think I said when I was on last time, just the risk-free rate alone, the 30-year going from roughly 1.8 to 3.8 should have caused the equity markets to be down 30%. And they've been down far less. Now, again, I'm not predicting equity markets are going to suffer here, but equities are saying things are a lot calmer than the credit markets. I think that's what we need to focus on.
Hey, Gershon, I'll focus on that right now. Great to catch up with you, sir, as always. Alongside Subhadra Rajappa, to the two of you, thank you. Your equity market down 0.6%. Coming up in the morning calls and later, back to the equity market. Big bank earnings coming to a close. We'll get the scorecard from Ken Leon at CFRA and why TPW's Jay Pawlowski is staying bullish on some of these names. That conversation just around the corner.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Was going to keep rating World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make
Minutes away from the opening bell, equity futures down about 0.5%. Let's get you some morning calls. First up, UBS upgrading ExxonMobil to a buy, saying the company is best positioned to outperform given its improving balance sheet. The stock's down 0.8%. Gordon Haskett upgrading Walmart to buy, expecting the retailer to benefit from a softening macro environment. And finally, RBC downgrading Rivian to sector perform, seeing limited catalysts and growing risks to margins. We're down there by 2.4%. Coming up, the big banks wrapping up earnings season as big tech gets underway. We're breaking down the results with CFRA's Ken Leon and TPW's Jay Pawlowski. Equity futures down about 0.5%. Your opening bell up next.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody's talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
Coming into Wednesday with the equity market on the S&P 500, close to the highest since early February. Futures backing away just a little bit. We're down 0.5% on the S&P 500. We're down about 0.8% on the Nasdaq. Some weakness in the Nasdaq with the bond market repricing once again. Yields up. There's the opening bell, switch at the board and get to the bond market. Yields up and away by 3 basis points on a 10-year, 360.61 on a 2-year. Front end of the curve very close to 430. A little bit earlier on in the session, your 2-year right now. Yields higher by 4 basis points. Let's call this 424. Off the back of that, just a touch of dollar strength. Euro dollar negative by 1/10 of 1%, 109.55. And crude, a break of 80, 79.60. We're down by 1.6%. 20 seconds into the session, your equity market shaping up as follows. We are negative by 0.5% on the S&P. On a broader Nasdaq, we're down by about 0.75%. One stock to watch at the open is Netflix, falling after reporting disappointing subscriber growth. This is the company prepares to crack down on shared accounts in the United States. Abby potentially giving the company a lift later this year.
Yeah, indeed. And it's been a bit of a wild ride because in after hours yesterday, the stock had been down about as much as 12%, but now down far less than that. And I think it has a lot to do with that expectation that we could see growth on that prototype, those 4 countries in Latin America where they are, in fact, requiring paid sharing for the streaming services. So the idea that that's going to help in the future. But right now, relative to why the stock is down and why it had absolutely plunged, it has everything to do with subscriber growth. The last quarter that they reported, light right across the board, the outlook a little light. And you can see that subscribers going in the wrong direction out of the pandemic peak, again, missing, coming in at 1.75 million for the first quarter. The estimate had been for above 2 million. The stock is up, though, in a big way out of its bottom from last year. In fact, it's a double. It's been a wild ride for this stock. And that really reflects, I believe, John, what you were talking about, those growth expectations, that if they do put in the paid sharing aspect, that could really boost growth for the company later this year. Another thing that they talked about, I'm very sad about, their legacy disc business is going away, but that could, in fact, also boost growth if some of the people who use disc do, in fact, subscribe as streamers, John.
I had no idea the service still existed. I had no idea people still used it. Abby, thank you. DVDs, still. UBS like what they see in the results. Netflix say this, or rather UBS says this about Netflix. We see Netflix as the main beneficiary of easing competition. This will drive upside to subscribers and pricing power while also keeping a lid on content costs. We expect growth to inflect in Q3 and beyond. That stock down by about 3.8%. Another name we need to talk about, Tesla. Cutting prices again in the US. It's the second time this month, with quarterly results coming after the closing bell. I want to get to David Welsh for more. David, the stock's down by about 3%. We're doing it again. And I've lost count, David, how many times this has happened this year.
Look, this is the second price cut just this month, and prices were, last time you and I talked about this, John, it was cumulative price cuts of over 20% for all of the models. Now, they do have 25% gross margins, and that's why they've been able to do this, to basically keep total profits up by ramping up volume even if margins get lower. But that can't happen forever. They keep cutting these prices. And remember, this is also the quarter that they are ramping up production of the Gigafactory in Austin. So they've got more production coming online. They've got to sell that. They've had disappointing numbers both for the older Model S and Model X, and sales numbers overall. And also the last time they reported sales, they built more than they actually delivered. So there's some softness there. I mean, Tesla's still overall a growth company compared to last year, but it's not the meteoric growth company that it once was, and I think they're just giving margin away to keep all of their plants busy at this point.
David, you and I are going to talk about this name again tomorrow. When we get earnings a little bit later, that stock is down by 3% this morning at least. Year to date, still flying year to date, had a pretty decent year so far relative to the pain it's gone through over the last couple of years, the last 12 months particularly. I want to talk about financials and Morgan Stanley wrapping up big bank earnings with a trading miss. The CEO, James Gorman, saying this: the firm delivered strong results in a very unusual environment, demonstrating the strength of our business model. Equity and fixed income revenues were strong, although investment banking activity continues to be constrained. Now, Katie, what they say is strong, other people just call a miss.
Oh, big time. I mean, if you really parse through these numbers and look at what's moving the stock, it seems to be what was a huge drop in net income. That measure dropped 20% from a year earlier, coming in at about $2.84 billion. That was even though you saw a narrow beat in both trading and the banking segments, and it's really overshadowing what was very good news from its wealth unit that beat first quarter expectations. But you take a look at shares down 2.4% as trading kicks off. And that drop in net income, it stands out in a bad way, John. As you can see, if you look at all the other big banks, they reported a rebound in that measure, leading to the highest cumulative net income haul in at least over a year. JP Morgan in particular brought in about $2.9 billion. So Morgan Stanley definitely the odd one out here.
Stock down 2.4%. Katie, thank you, as always. I think it speaks volumes about the moment we're in, that our chief Wall Street correspondent is not talking about Goldman, Morgan Stanley, Bank of America, Citi Wells, or JP Morgan. Sonali Bassek's going to talk about Western Alliance, which is up by about 17% this morning. Sonali, this is where the focus is.
Man, can you believe it? And what's interesting here is not only deposits stabilizing, drawing in more at the beginning of April, really pushing aside some of the fears the market has had, but the idea of some asset sales that shored up its balance sheet even further. So you're finding some relief for the regional banks in the market. Just take a look at all that green on the screen. You have a Western Alliance, of course, up as much as it is. Citizens had also reported, and while deposits are stabilized there as well, you do have them cutting the net interest income guidance. John, I'm a lot like you in this fashion. I don't believe the trading at first when I see it sometimes, because as the market bakes in these pressures on profitability, how does the story change? Now, again, these stocks have sold off very significantly as well. It's not all a deposit story at the end of the day. But, if you think about it, we have a lot more ahead of us. Tomorrow is actually the bulk of the earnings day when you look at the banks ahead of us: East West Bancorp, Comerica, KeyCorp, Truist, Huntington, Fifth Third. Today, after the market, you have Zions Bank. Zions is very heavily exposed to commercial real estate. You had Morgan Stanley, Wells Fargo already warning on commercial real estate as it stands. You had Ally really down today because of the auto sector. So I think once we get past the bulk of the stabilization story, then you start looking to the loan story and the individual pockets of the market that are facing pressures.
Sonali, first is about surviving, and then it comes back to profitability. Looking forward to the conversation tomorrow. Also had one eye on First Republic reporting Monday. That's going to be a big one to watch too. The broader equity market on the S&P 500 a little bit lighter, softer, lower this morning. We're down by about 0.4%. Joining us now to discuss the banking sector, CFRA's Ken Leon. Ken, wonderful to catch up with you, sir. As always, some of the big banks have dominated. We know that, Ken. The small ones, are they recovering? Have they recovered from what you've seen so far, Ken?
The landscape changes and the narrative is focused more on traditional lending and deposits plus risk to commercial real estate. So as you move downstream to the smaller banks, these are going to get the attention of analysts on the street. The larger banks, it's essentially, we just have very weak markets, both for trading, equity and fixed income, plus all areas of investment banking. Surprisingly, and the tone on Bloomberg has been kind of critical of Morgan Stanley, But I like where we are, mostly because as we go to the second half of this year and next year, there's a great opportunity for gaining wallet share in investment banking and also a rebound in trading. The wallet share will come from Credit Suisse out of the market. Morgan Stanley's weakest geography was Europe. It was down 25%. Everywhere else was like down slightly. So you put it together, Morgan Stanley with a 3.5% yield, as Tom Keene says, a 17% return on equity, and its worst quarter probably in the last 6 or 8 quarters. And you're really in a trajectory opportunity for the second half when the Fed stops raising rates. We move a little bit away from a risk off to a slightly risk on environment into next year. Morgan Stanley looks really good here, and that's why we have a strong buy.
You like that name, Ken. You also like Bank of America, buy. Citi, buy. JP Morgan, buy. Where did the positives come from for those names later this year?
Well, it gets back to your first question. The middle of March, we went from hold to strong buy on Goldman and Morgan Stanley because they didn't have the risk that we saw in the banking crisis, and they're less dependent on net interest income. For the Bank of America and even JP Morgan, they will quietly gain market share in every local market as we see more business flowing their way, both from consumer and small business. The real wild card here, and this is a conversation maybe a month from now, is really what is regulation in the post-crisis that we saw? What will that mean for all of the banks, but in particularly for the large banks in terms of whether they may need to keep higher regulated capital, which may kind of handcuff future dividend growth and share buyback. To me, that's the biggest risk, John, to the biggest banks.
They look more and more like utilities with that in mind. Ken, thank you as always for making some time for us on what I know is a really busy morning for you, Ken. We're going to be talking about that, no doubt, before next month. We'll talk about that over the next couple of weeks. TPW's Jay Pawlowski making the case for stocks writing this. We expect to see equities break up and out of their range, with the next Fed decision serving as a catalyst. Jay Pawlowski joins us right now. Jay, wonderful to hear from you, buddy. As always, you have been and remain bullish the banks through all of this, Jay. And right now it seems to be paying off. Jay, just walk me through why.
Well, John, I think we have what we've been calling a curtain of FUD, or fear, uncertainty, and doubt across the market. Let me just give you a couple of examples. You know, the smart money example is the hedge funds are the most short the S&P that they've been since 2011. The broad institutional market, the B of A fund manager survey, longest period of extreme pessimism in the history of that report. The public, that other network reports that the public in the U.S. has never been more negative on the current and future outlook of the economy. And then the policymaking community, the World Bank and IMF meetings last week. I have a friend who's attended for 30 years, called me from D.C. and said he's never seen such negative sentiment. So you have this tremendous negativity out there, which is not matched at all by the economic environment, which is growth of 2%, not matched at all by the earnings outlook for companies coming in, again, Q1 here, better than expected. And I think to the point of the quote you referenced, looking for a situation where you have earnings, you have the sell-side equity earning analysts forecasting accelerating earnings in the second half of the year, versus the fixed income investor community expecting a recession and rate cuts. One of those two is going to be wrong. We think it's the fixed income outlook is going to be wrong. The Fed meeting, the Fed is going to go on hold, and that is going to catalyze this break out of the trading range that we've been in really almost a year now, John. For 240 days and counting, the S&P has been around 4,000. We're testing the upside of that range, 4,200. We think the Fed meeting is going to serve as the catalyst to break up and out rather than down.
Jay, I wonder where that leaves the bond market then, because you mentioned the IMF. I was there too. Incredibly gloomy. Really, really downbeat. They put out that blog piece, that post, that report, call it what you will, about pre-pandemic interest rates making a comeback. Jay, what did you make of that?
They're just completely wrong, John. I mean, look, completely wrong. And you know, the history of these gatherings is you take the opposite of the consensus, right? It's the same with the Davos crowd. You take the other side. It reminds me of the famous quote from Bernard Baruch. The main purpose of the stock market is to make fools of as many people as possible. And that's what's going on. You have all these people talking about going to cash. Well, guess what? In March, with the SVB and Credit Suisse failures, cash was one of the worst performing assets. Way underperformed equity, underperformed high yield, etc. So we think the fixed income market is not attractive. We've been underweight fixed income for the last year or so, and that hurt us, you know, obviously when rates tumbled there for a little bit, but now they've bounced back, and we see that middle path, John, that you and I have talked about for a year.
Yeah.
High nominal growth world, and that's what people continue to miss, even with the earnings. With the U.S. having nominal growth of 6 or 7%, it's no surprise that sales are growing at 8 to 10%, and earnings are going to be okay. And as we get through this period and go forward, as your prior guest just said, we look into 24, even the most bearish of people are bullish on 2024. So time is running out for the bears. We're getting to that crunch point. We think it's going to be the Fed meeting. It's going to go on hold. That's going to open up the rest of the world as the dollar weakens. And as you know, we have a bias and have had a bias.
Yep.
The non-U.S. markets, continue to believe that's where we want to be.
Jay, you know markets can be brutal. You talked about making a fool of people. If you want to make a fool of people these days, ask for a forecast and just wait 5 minutes, because this world changes so quickly. I've gone through this a few times with you, Jay. I remember January, soft landing, February, no landing, then it was March, hard landing, April, we've still got to conclude what April's about. Jay, if you believe we remain in this high nominal growth world, I just wonder why you also believe the Fed can pause in that world.
Yeah, because I think we're having a situation where inflation is decelerating, John, and we're going to get to lower inflation. We clearly are on the path to that. We know that the second half inflation numbers are going to be benign because the shelter component is going to collapse, as we know from real-time evidence. And look, I think the FUD curtain is obscuring some major global policy positives that people are just missing because they're so focused on the crisis du jour, as you pointed out. Let me give you 2 or 3. One is, the most important, is the return of industrial policy to the U.S. This hasn't happened in 70 years, and the combination of the CHIPS Act, the Infrastructure Act, and the Inflation Reduction Act means that we have, for the first time in 70 years, since the 50s, public and private spending, which is leading to things like non-residential construction running up 20% year over year. So when you wonder why the housing collapse did not lead to big unemployment in construction, it's because all those folks are working in non-residential factory construction to deal with semiconductor fab plants, electric vehicle, battery plants, all coming into the United States. So that's a major one.
Yep.
And then you have in Japan, you have yield curve control going away. In China, you have domestic demand-driven growth as opposed to fixed asset growth. And in the U.S. and globally, I expect that we're going to see central banks accept and validate the high nominal growth world with an inflation target that's not going to be 2%. Again, we've talked about it, 2%, purely arbitrary, only been the number for a decade. We think the Fed and others are going to kind of not declare victory, not come out and say in a big press release, oh, we're changing our inflation target. They're just going to let inflation sit around 3%.
Tolerate it.
And validate the nominal growth world.
Yeah, you're not the only one thinking that, Jay. Others too. Jay, thank you, sir, as always, on the curtain of FUD, fear, uncertainty, and doubt. Your equity markets, 16 minutes into the session, we're down about 0.5%. Up next, Secretary Yellen set to address economic ties with China.
The historic investment that the president has already made, they'll put the United States on a path to outcompete China. You hear us talk about that often, for jobs and investments, building the future of transportation.
That conversation next.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The historic investment that the president has already made, has secured to build more electric cars here in America. They'll put United States on a path to outcompete China. You hear us talk about that often for jobs and investments, building the future of transportation. This is what we think it's going to deliver for the American people.
This is one to watch. Secretary Yellen delivering remarks on U.S.-China economic ties tomorrow. The Treasury writing in a statement her speech will, quote, underscore that in its bilateral relationship with China, the U.S. proceeds with confidence about the enduring fundamental strength of our economy. This is G7 ministers a call for greater engagement with China on global issues. AMH joins us now down in Washington. Morning, Anne-Marie.
Good morning, John. As you said, this is definitely one to watch. It's Secretary Yellen's most extensive speech to date on U.S.-China economic policy. And what she's going to want to outline is, of course, U.S. national interests at play, especially security interests, as well as making sure there's a level playing field when it comes to Beijing. That is really a nod to, obviously, Chinese subsidies going to Chinese companies and also intellectual property rights. But then there's going to also be a lane where potentially Beijing and Washington could collaborate. And for this administration, it's going to be climate change as well as debt distress. But the timing of this speech, Jonathan, is so interesting. You were here in Washington, D.C. last week, and the IMF talked about fragmentation, aka two polar worlds between the United States and China, and how that could weigh down global growth. It also comes at a time as the U.S. really wants to line up partners. They want a multilateral approach to confronting Beijing. That means getting European allies like France on board. And Emmanuel Macron just left China saying he does not want to see a decouple from Beijing.
AMH, politics. Secretary Yellen, not exactly the greatest politician, fantastic labor market expert who we all respect. Is this going to be a Treasury Secretary that takes on a bigger role in a way she hasn't before to frame the politics around this issue?
Well, I think for her, she's going to want to stay what she's comfortable with, right? So she's going to want to talk about and really lean into the economics surrounding this relationship. She's not going to want to touch things like the spy balloon or the Taiwan Strait, issues that have really derailed some of the communications we were expecting to see from this administration to Beijing. Remember, she recently sat down in Zurich with Liu He, and they talked about her attending China in the spring. Now, those plans are in the works, but they aren't finalized yet. So this is really the warm-up act before she makes that trip to Beijing, Jonathan.
MH, you and I are going to talk about this tomorrow. Looking forward to that address from the Treasury Secretary, Janet Yellen. About 23 minutes into the session, equities negative by 0.5% on the S&P. On the Nasdaq, we're down about 0.6%. Coming up next, your trading diary.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
After 2 days of gains on the S&P 500, we back away just a little bit, about 25 minutes into the session. We're down about 0.5% on the S&P. As yields back up again, the Nasdaq backs down by 0.6%. That is the story in the market. Let's get to the trading diary for you just briefly. The Fed's beige book coming out at 2 Eastern time, plus Fed speak continues with Goolsby and Williams, Tesla and Zions Bancorp reporting results after the closing bout. Another round of claims on Thursday and more Fed speak. Waller, Mester, Bauman, Bostic, Harker, and finally we round out the weeks with US PMIs coming up on Friday. From New York City, that rounds out the morning for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
On the product may read made in the USA, but the sign on the CEO's door often says, Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in prize stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far.